Good morning, everyone, and welcome. I call this January 2021 meeting of the Ncua Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public via a live webcast only. The public may access the meeting by visiting the agency's homepage and clicking on the provided webcast link. I'd also like to note that all participants in today's webcast are also joining us remotely. With that, I'd certainly like to thank Rob Foster and the OCIO team for the ongoing support they provided us while we have all worked in a remote posture. Before we begin officially today's proceedings, I would like to take a moment to address the attack on the Capitol last week. I can neither deny the obvious nor defend the indefensible. As I noted in a message to the Ncua staff, I'm a public servant who has sworn an oath to protect and defend the Constitution. As such, I was deeply shocked and profoundly saddened by the riot that took place at the seat of American democracy. Our country has faced great challenges in its past and has overcome them, and it is my great hope that our nation will come together after this incident as one nation, united as Americans. Before I call up our first agenda item, I would like to thank the Ncua staff for all of their hard work in executing today's robust agenda. The first item on our agenda today is a board briefing on the Access Initiative, Advancing Communities Through Credit, Education, Stability, and Support. Staff presenting Matt Valores, Director, Consumer Financial Protection, Jean Marie Comathy, Deputy Director, Credit Union Resource and Expansion, and Marvin Shaw, Staff Attorney, Office of the General Counsel. Good morning and welcome, all of you.
Good morning, Chairman Hood, Vice Chairman Hoffman, and Board Member Harper. This is Matt Valores. Jean Marie, Marvin, and I are pleased to provide you with an update on the Advancing Communities Through Credit, Education, Stability, and Support, or Access Initiative. If we could move to slide 2, please. Thank you. When launched this past October, the Access Initiative was announced with some primary purposes in mind, that being to help credit unions bring more people into the mainstream financial system, ensure underbanked and underserved people and communities have access to affordable financial services, and broaden employment and business opportunities, and reduce regulatory burden and foster greater innovation and flexibility so credit unions can meet the evolving needs of their members. Next slide, please. Let's take a moment to highlight the organizational framework of Access. You'll note here on slide 3, there is a steering group to help advance the goals of the initiative and lead and coordinate with all the work groups so they may achieve their objectives and deliverables. There are also 2 supportive working groups, the Data Analysis and Reporting Work Group, which is designed to provide consistent and accurate data to the working groups and steering committee, and the Communication and Messaging Work Group, charged with developing communications to keep internal and external stakeholders informed of the Ncua's efforts and to ensure consistency with messaging. This overarching approach will provide support and vision to the underlying working groups shown across the bottom of the screen. Just to touch on them quickly, you have FOM, or Field of Membership, which will continue to research how the Field of Membership regulations may be modernized to assist in credit union growth and outreach. We'll discuss FOM a bit more later in this presentation. Moving over to low income, which will evaluate the improvements to the low income designation criteria and related processes and procedures. In the bottom middle, you'll see MDIs, Minority Depository Institutions. With this working group, we plan to research, identify, and recommend how Ncua may expand its support of MDIs and encourage chartering of new minority credit unions, as well as encourage more credit unions to self-designate as an MDI. The new charter work group will seek to create a supportive environment to charter new credit unions by modernizing regulations and supervision and offering tools and resources for this process. And lastly, we'll make sure the Consumer Engagement and Outreach Group evaluates ways the Ncua can support credit unions and the and underbanked through various outreach efforts, using websites like ncua.gov and mycreditunion.gov to foster greater membership and inclusion in mainstream financial services. And before I move on from this slide, I want to point out a key guiding principle of Access was to leverage the diversity of NCUA's workforce. Each of these subgroups highlighted here are comprised of a broad cross-section of NCUA staff to bring together all viewpoints for innovative thought and discussion. Next slide, please. Thank you. Moving on to slide 4, we'll start touching on some focus areas for each of the foundational pillars of Access, starting with credit. Affordable small dollar lending in general, including our PALS 1 and PALS 2 programs, will continue to play an important role in expanding the availability of credit to stimulate economic growth and improve the financial well-being of all Americans. Likewise, this slide also highlights various ways throughout this pandemic that NCUA has provided regulatory flexibility to significantly streamline the process for credit to reach communities in need. And now I'd like to turn the mic over to Jean Marie to touch on some efforts being considered or implemented under other of the Access pillars. Jean Marie, over to you.
Thank you, Matt. Starting on the next slide, slide 5, I'd like to highlight the actions we've taken to provide educational resources to credit unions and their communities. Our webinars provided critical information about topics such as those seen here. We are planning a full slate of webinars in 2021 that will address operational guidance, consumer assistance, and critical current topics. As the schedule is finalized, we will publish and advertise the webinars through our usual channels of the website and other social media. We also continue to offer resources and education through a variety of web channels. These resources are available to the general public via our websites and to credit union staff and volunteers through our learning management service. We continue to add new courses and will focus topics such as board governance, operational guidance, and compliance issues. If we could move to the next slide, please. On slide 6, you'll see that Access is focusing on stability through the 3 particular areas highlighted here. Our 2021 Minority Depository Institution mentoring cohort will begin their program this week. We are planning regional roundtable events to reach out to the MDI credit unions and learn what resources and services they need. And we continue to look at the options for providing resources to both our MDI and low-income designated credit unions. As mentioned earlier, we encourage credit unions to seek these designations if eligible to ensure they can take advantage of the resources offered both from NCUA and other partners. The new charter work group is using the Management Development Program Project Teams report as a starting point to look at changes to the chartering process. We are working to make the charter process more efficient and effective, streamlining the process and offering more information and training to our organizing groups. We are developing plans to seek input from the credit union industry on improvements we can make, as well as looking at the need for capital and operational support. We are evaluating all the recommendations presented, as well as other input to determine what is feasible, what is legal, and how NCUA can best improve the chartering process. I anticipate changes to come both in the short and long term from this project. On the current slide, slide 7, we're focusing on the Field of Membership work group, which is working with the Office of General Counsel to improve policy and improve processes. They are taking a holistic approach to ensure the Field of Membership regulations are conducive to the credit union industry as it is today and into the future. We recently released letters to credit unions to provide information and resources for those credit unions who want to amend their fields of membership. These letters included information about recent regulatory changes, as well as templates and guidance for the application packages. We are also looking at additional regulatory changes, including items such as streamlining the required business and marketing plans, reviewing affinity groups included with local communities, and evaluating national benchmarks that will assist credit unions in evaluating their options. These items, along with others, require research and review prior to implementation to ensure they comply with our Act, are reasonable and efficient, and don't cause undue harm in other areas. And with that, I will pass it back to Matt to finish our presentation, starting with slide 8.
Thank you, Jean Marie. This is Matt again. The final pillar of access support includes diversity, equity, and inclusion. As we point out on slide 8, NCUA has multiple tools and resources available for credit unions to use in their diversity inclusion efforts, such as the annual Voluntary Credit Union Diversity Self-Assessment Tool, information supporting the business case for diversity, and a guide to supplier diversity and its accompanying set of frequently asked questions. Another example of the agency's efforts to more broadly advance communities can be seen in our Second Chance program. This policy change expands the list of exceptions committed by young adults that will not require an application to the NCUA board, thereby helping to expand potential employment opportunities for more Americans. And lastly, on this slide, we'd be remiss if we didn't acknowledge our commitment to encourage the use of fintech and innovation to expand financial inclusion and drive consumer access to affordable financial service and products. NCUA will also work with credit unions and fintech companies to harness the opportunities that innovation provides to support financial inclusion efforts, make financial services more accessible to underserved communities, and to ensure the effective use of new technology development that are consistent with applicable consumer protection laws. Next slide, please. Thank you. And to close our presentation, slide 9 highlights some of the next steps we plan to take under the Access program. We plan to issue requests for information to solicit stakeholder input on ways this initiative can fulfill its mission. Also, the agency's 2021 annual performance plan, before the board for consideration later this morning, outlines a requirement for the Access Steering Group to deliver an action plan by March 31st, which will inventory key events and deliverables for Access throughout the year. And for more information on this important initiative, I would direct stakeholders to NCUA's Access webpage at the link on the screen. Thank you for your time this morning. This concludes our presentation. Jean Marie, Marvin, and I would be happy to address any questions you may have.
Great. Well, thank you, Matt, Jean Marie, and Marvin, for this update and for your dedication in supporting this important initiative. As many of you all know, this is an issue that I've cared about and supported throughout my professional career in financial services, almost 30 years now. And Matt, I want to personally thank you and your fellow Access co-chair, Martha Nenichuk, for providing the focus and direction needed for this initiative to advance and succeed. Sadly, Martha was unable to be here today, but I certainly do appreciate all of her hard work on this initiative, and I certainly appreciate you, Jean Marie, as well, for filling in for her today. NCUA's Advancing Communities Through Credit, Education, Stability, and Support, or Access initiative, is bringing together agency leaders to develop policies and programs that support financial inclusion within the agency and more broadly throughout the credit union system. By building on the NCUA's past and current financial inclusion initiatives, Access, we're focused on meeting the financial services and financial literacy needs of underserved and diverse communities and expanding their employment and procurement opportunities. We must recognize there is indeed no silver bullet to combating inequity. Instead, we need to carefully consider and develop a comprehensive agenda that puts financial inclusion for underserved minority communities at its core, while focusing on those of modest means, as asked of us in the Credit Union Act. I am glad that we are able to be briefed on this today. Now, everyone, I do have a few quick questions for you. Can you please elaborate on modernizing the chartering process for new charters? And can you please discuss how we plan to assist MDIs, most notably?
This is Jean Marie, and I'd be happy to answer that question. We are exploring a variety of ways to modernize the new charter. In the short term, we're looking to reorganize the process to focus on the most critical aspects of the charter process, including planning for capital, identifying a mentor, and developing the field of membership. We will provide additional information on our website to help organizing groups understand the process and navigate through the steps. We are currently revising the chartering guide, which has not been updated since 2014. And we're also developing plans to provide additional training and tools for organizing groups to use when navigating through the chartering process, such as templates for pro forma financial statements and model business plans. As the work group moves forward, we anticipate more changes to the chartering process, but we're still evaluating what those changes might be. For minority depository institutions, we will be using our regional roundtables to learn what the MDIs need in resources and to explore tools and opportunities we can provide to them. We will continue to offer training, seek ways to facilitate communication, and participate in industry events that focus on MDIs and their particular needs. Thank you.
And thank you, Jean Marie. I really do appreciate it. And I'm very pleased to see one of the recent reports from your group that we have about 12 MDIs in the pipeline that will soon be getting their charter. So I certainly look forward to seeing those move along. And it's one of the things I may have mentioned in my Wall Street Journal op-ed. I do think that credit unions, and especially our MDIs, can really help provide healing in a lot of our urban areas that are so desperately in need of financial services. So thank you and your team for your hard work. And maybe this is going to be to you, Matt, and it's more of an ask than maybe a question. But as you, Martha, and your steering group members move forward to finalize the access plan for the year and solicit industry output or outreach efforts, can you just please make sure that your financial inclusion efforts include some of our most marginalized and overlooked constituents, and those would be members of the disabled community? I know I just received an email the other day from the American Foundation for the Blind and a few others just acknowledging the work that we've been doing around financial inclusion, and I just wanted to ask that we please make sure that we're looking at that group as well, of those with disabilities. So let's continue to make sure we're doing all we can to reach our members of different communities. Don't know if you need to respond to that or not.
No, Mr. Chairman, I certainly hear you, and we'll certainly make sure we focus our efforts across all of the pillars to make sure we're hitting on all members of our communities, and we'll pay special attention to the needs of persons with disabilities. So you have our commitment on that.
Great, sir, and I certainly do thank you for it. And this is a bit of a non sequitur, but as we've talked about the MDIs and the work that they're doing, I would be remiss if I didn't remind the industry that tomorrow is the deadline for our 2020 Voluntary Credit Union Diversity Self-Assessment. So credit unions, please, if you've not completed this self-assessment, please do so. Please know that this is confidential, it's anonymous, and it has nothing at all to do with your examination. So do know that. But we really do want to have that data so we can really know where we are today so we can get a roadmap for where we want to go tomorrow. I have no further questions. I'd now like to recognize Board Member Harper. The floor is yours.
Thank you so much, Mr. Chairman, and I echo your comments with respect to the diversity self-assessment. It is a very important tool that I also have been encouraging credit unions to fill out. Before I begin my remarks on this agenda item, I also want to address last week's bedlam and insurrection on Capitol Hill. It was appalling and gut-wrenching to watch, especially for someone who spent more than 14 years working on Capitol Hill. We the people is what makes our democracy resilient and strong, and I have every faith that our country will survive this assault on our freedom, liberty, and justice. For the good of our nation, our future must be one of healing and working together to form a more perfect union, maintain justice, and ensure domestic tranquility to promote our collective welfare, peace, and our prosperity. Congress created federally insured credit unions to advance these very important objectives. Now, turning to the Access initiative itself, thank you, Matt and Jean Marie, for your briefing on the work completed to date, as well as the plans going forward. I share the Chairman's interest in these important issues, and I believe that the Ncua must do all that we can to advance economic equality and justice. In working to enhance support for minority depository institutions, expanding access to affordable credit, and improving financial literacy resources, we can begin to address the disparities caused by centuries of systemic discrimination that have been exacerbated by the pandemic. We can also ensure that the cooperative nature of the credit union system lives up to its mission of meeting the credit and saving needs of consumers, including those of modest means. With respect to supporting minority depository institutions, it is very important that we work to preserve them. In that regard, I am aware that the Federal Deposit Insurance Corporation has developed a process whereby minority depository institutions seeking to merge with another minority depository institution in receivership are given extra time to review the books and develop a bid. They also receive technical assistance in understanding the bidding process. The FDIC has found this process can help it to merge two minority depository institutions together. I think that this is something that the NCUA should consider and implement. Jean Marie, will the Office of Credit Union Resources and Expansion work with others in the agency, including the Office of General Counsel and our field offices, to explore this option?
Board Member Harper, this is Jean Marie. And yes, I absolutely believe the Office of Credit Union Resources and Expansion can work with others in the agency to explore this option. I believe the Minority Depository Institution Working Group under the Access Initiative is evaluating a variety of different options, and this is certainly one that we can put in their queue and have them work with the Office of General Counsel, the Office of Examination and Insurance, and the field offices to explore, to see what options we have and what we can do to facilitate mergers between two minority depository institutions to try to preserve as many as we can. Thank you.
Thank you so much for that commitment. These efforts have the potential to preserve the distinct nature of minority depository institutions. The agency can also go a step further by advancing initiatives to close the wealth gap. As you move forward with implementing Access, Matt, will you and your team in the Office of Consumer Financial Protection work to develop policies and implement projects aimed at helping people of color to build wealth?
Hi, Mr. Harper. This is Matt. Yes, we certainly will do that. My team, as you know, is on the front lines with consumers, dealing with them every day, whether it's through the Consumer Assistance Center, taking in calls from the public. They use those opportunities to provide information, get information out into the hands of consumers so they can make more informed decisions. We'll also work with our sister agencies through the Financial Literacy and Education Commission to make sure we're meeting that mandate also. And then I think I can tie that also into even looking at this Access initiative. We'll certainly use our outreach efforts, particularly requests for information, but outreach events, to hear from all members of communities, including communities of color, to better understand barriers to building wealth. I think it's a good goal to have, to look for long-term solutions to advance communities so all individuals have the ability to build wealth and find financial independence. So throughout this process, we'll be sure to engage with all the board offices to make sure we stay focused on this particular aspect because it is indeed important. I'll turn it back to you, sir.
Thank you so much, Matt. You know, research has shown that there are really three ways in which to build wealth and close the wealth gap. One of them is to purchase a home, and certainly credit unions can and are involved in that. Another way is to open and regularly fund a retirement account, and I know that credit unions are also working there. And then finally, the third way is to start a business. And I know that many credit unions have been working to help the smallest of businesses get started, and I've encouraged credit unions to step up during this pandemic to do even more to help people of color who have been disproportionately affected by this pandemic and disproportionately affected with business closures to do something. So the Access Initiative has the potential to work to close the wealth gap, support minority depository institutions, and we also have the potential to use the Access Initiative to enforce fair lending laws. In doing so, we will help ensure that people of all colors can buy a home, purchase a car, or finance college without being subject to discriminatory terms. In doing so, we will lift all boats and live up to the cooperative philosophy at the heart of the credit union movement. Thank you, Mr. Chairman. I have no further comments or questions.
Great, thank you, Mr. Harper. I'd now like to recognize Vice Chairman Hauptman.
Good morning, guys. I thank the Access team for all their work. Obviously, Access, as we describe it today, that's an acronym. And they have done terrific work, the Access team. But I like to think of credit unions in general as the Access team, meaning credit unions were founded on inclusion. Their original purpose were people that did not have suitable options for financial services. So inclusion is not an initiative of the credit union movement. Inclusion is the credit union movement. One way to include people is to make it easier to do new charters, right? Now, provided these are stable new credit unions that don't present any risk to the share insurance fund. Can I ask the team, how do you think we can better communicate to the underserved world, right? That could be geographic, that could be any other things. How do we better communicate that you, Americans, can form a credit union? You can start a de novo credit union, and here's the process, and we're going to try to make it as painless as possible. That's my question.
Good morning, Mr. Hoffman. This is Jean Marie, and I'd like to offer an answer on that. I think there's a variety of ways that we can reach out to the underserved communities in America to let them know that chartering a credit union is an option for them. In the Access Initiative, we have a community and outreach working group, which is looking specifically at this option. It's looking at how do we get to the people who are not served by a credit union and let them know that that's an option for them. So providing information to people about how to start a new credit union will be part of the focus of that group. I think the new charter working group is also looking at the information that we offer through our website and through our other web channels to make sure that we're using that option to get out to people who may not know about starting a chapter. I think we also need to explore how we work with our partners, how we work with the credit union leagues, how we work with the credit unions that are out there that may not be able to reach into a community that needs a credit union, but might be able to help a group that would be willing to start one. Mentoring for new charters is a critical factor in their success. So if we have existing credit unions that are willing to mentor an organizing group to start a new charter, that can be very beneficial. I think it's all in how we communicate and using a lot of different channels to communicate and having information readily available that's easy to understand about a process that is easier and efficient to do. Chartering a credit union has some critical factors, including gathering the appropriate capital that's needed, having the appropriate staff in place to be able to manage the operations, and having a business plan that's reasonable and that will help a new de novo credit union survive. Those are all of the things that the new charter working group is looking at and working to make available to those who want to charter a new credit union. Thank you.
I appreciate that response. That was quite informed, and you've obviously thought of these things quite thoroughly. I'll ask one more, then I'll conclude, which is just as an example, my home state of Maine, as you know, last year the Harvest Credit Union opened, agricultural, and I believe from start to finish it took 6 years before they could open the door. Obviously, not everyone out there is going to have the patience of Job to spend 6 years. Are there ways, and we don't have to go through them right now, obviously, but do you think it would be worthwhile to look for ways to update the process to 2021 to make sure there is not one superfluous document, there is not one step that can't be eliminated or combined to make it easier to do? Because obviously the best consumer protection is a competitive market offering more choices.
So this is Jean Marie again, and thank you for that question, because that is the very first step that the new charter working group has taken. As we are evaluating the chartering guide that has been online and not updated since 2014, we began looking at what the process for chartering was and which steps could be combined and what order those steps could be in. And we are advising and recommending that we move to a three-phased approach. We are looking at what those phases would be and how to communicate those, and to help the organizing groups understand the critical things have to be looked at in phase one. And if you can pull those together, we can move you to phase two and help you get there. We eventually would like to look at what the timeframes for reviewing documents and reviewing submissions are, and we are also looking at what steps are needed and what steps aren't needed. So we really are looking at the process and what we can do to make it more efficient right away. That's one of our very first steps. Thank you.
I appreciate that answer, and I look forward to following up with you and the Access team to review that process, and all in the effort of consumer protection. Somebody who has unattractive products available to them, it is useful, I suppose, to have regulators that have compassion, and we're checking the documents to make sure they're not being overcharged. But what they want more than anything are better products and services. So I consider the new credit union charter process to be a core part of consumer protection. I have no further comments. Thank you.
And thank you, Mr. Haltman. And again, I'd like to thank Matt, Jean Marie, and Marvin for your update this morning. The second item on our agenda today is Proposed Rule, Part 712, Credit Union Service Organizations. Staff presenting, Rachel Ackman, Senior Staff Attorney, Office of the General Counsel. Good morning and welcome, Rachel.
Good morning. I'm here today to present a notice of proposed rulemaking with a 30-day comment period that would amend the Ncua's Credit Union Service Organization, or CUSO regulation. The proposed rule would accomplish two objectives. First, it would expand the list of permissible activities and services for CUSOs to include originating any type of loan that a federal credit union may originate. And second, it would provide the board additional flexibility to approve permissible activities and services. Under the Federal Credit Union Act, federal credit unions have the authority to lend up to 1% of their paid-in and unimpaired capital and surplus and to invest an equivalent amount in CUSOs. Additionally, under the Federal Credit Union Act, the NCUA can regulate federal credit unions lending to and investment in CUSOs, but does not regulate CUSOs directly. A CUSO may only engage in an activity that relates to the routine and daily operations of credit unions, and the CUSO rule provides a list of pre-approved activities and services that relate to the routine and daily operations of credit unions. Historically, the NCUA has interpreted the statutory authority broadly to permit a federal credit union to lend to and invest in a CUSO that does most of the same activities and services permissible for a federal credit union. One activity that has not been historically permitted, however, is broad CUSO lending authority, and CUSOs are not permitted to originate any type of loan that a federal credit union may originate. Currently, CUSOs are only permitted to engage in four types of lending: business, consumer mortgage, student, and credit cards. In 2008, the NCUA considered whether to expand the categories of permissible CUSO lending, but declined further expansion at that time. This proposed rule would reconsider the position on permitting CUSOs to engage in all types of lending. Under the proposed rule, CUSOs would be permitted to originate, purchase, sell, and hold any type of loan permissible for federal credit unions to originate, purchase, sell, and hold. The proposed rule would also grant CUSOs the authority to purchase and sell participation interests, provided that they are permissible for federal credit unions to purchase and sell, which is consistent with the current rule. The proposed rule reconsiders the previous decision on CUSO lending because the financial services industry is quickly changing and becoming more digital. Federal credit unions' lending programs for all types of loans may benefit from the collaboration offered by CUSOs. The proposed rule would also amend the list of permissible activities and services to provide the board additional flexibility in approving new permissible activities and services. Specifically, the proposed rule would provide the board flexibility to consider additional activities and services without engaging in notice and comment rulemaking. This would make the CUSO rule for natural person credit unions more consistent with the rule for corporate CUSOs. Finally, the proposed rule would also seek comment on broadening federal credit union investment authority in CUSOs. A federal credit union's authority to lend to and invest in a credit union-related organization is provided for in two separate provisions of the Federal Credit Union Act. The NCUA has historically interpreted these provisions as referring to the same type of entity, a CUSO. The proposed rule solicits comments on whether the NCUA should reconsider its longstanding interpretation of the Federal Credit Union Act and adopt separate definitions for the types of organizations that a federal credit union may invest in or lend to, which potentially would expand the types of organizations eligible for federal credit union investments. I'm now happy to answer any questions that you may have.
Thank you for your presentation this morning, Rachel. I really appreciate it. As you stated, the extent of permissible CUSO lending has been considered and reconsidered by the Ncua board for many years now. In today's marketplace, credit unions may need to increasingly rely on pooling their resources to fund CUSOs to build the infrastructure consumers are demanding and to compete with captive auto lenders. Currently, CUSOs can already do many other forms of lending, such as student loans. Today's rule is a natural evolution and allows CUSOs to compete in a marketplace that is very important for credit unions. I certainly believe that now is the right time to reconsider the types of lending that are permissible for CUSOs and whether additional opportunities for collaboration will help credit unions, especially our smaller credit unions, our MDIs, our low-income designated, and our CDFI credit unions. In total, it's going to help them all remain competitive in a rapidly changing and dynamic financial landscape. Indirect auto lending is critical for credit unions, and today's proposed rule is, I reiterate, a natural evolution. Some may say that it's not appropriate to do this rule at this time until the Ncua has vendor authority. But I disagree with that assessment because waiting for that would then prevent credit unions from having all the tools they need to serve their member owners. In the midst of the pandemic, it's going to be access to affordable capital and loans. It's going to help our credit unions have the loans they need to get sustainable home ownership, the loans they need to get the cars to drive to and from work, and the loans, as we've mentioned, to educate their children. So in closing, I look forward to reviewing the comments on this issue from the public so the Ncua board can best determine how to move forward with this final rule. So Rachel, I now do have just a few quick questions. Do we think this proposal would represent a large expansion of CUSO lending authorities?
This is Rachel. Thank you for clarifying. We believe the proposed rule would permit a relatively modest expansion of CUSO lending authorities. As I said, CUSOs, they already do several core areas of credit union lending, including consumer mortgage loans, credit card originations, student lending, and business lending. This concludes my answer.
Great, thank you. And what types of lending do we think most CUSOs would engage in? Is there one that stands out?
We think it would primarily result in CUSOs originating car loans, auto loans, and small dollar consumer loans. And we can get a better feel for that once we hear from the commenters.
Great. I will be attuned to that as well because I do know there have been a lot of internet providers that are really competing in this space. And again, I want credit unions to have all the tools they need to serve today's member owner. One final question. Are we concerned that expanding CUSO lending authorities will increase the already competitive financial services market and result in additional competition for credit unions?
No, we don't expect the proposed rule to be disruptive to credit unions. CUSOs have been originating loans that are also core credit union lending products for over 30 years, and they haven't impacted credit unions negatively so far. But again, this is another area where we'll have a better sense once we hear from commenters. And this concludes my answer.
Great, thank you. And again, I look forward to receiving the comment letters as well. I have no further questions. I'd now like to recognize Board Member Harper. The floor is yours.
Thank you so much, Mr. Chairman. And Rachel, thank you for your work and your presentation on the Credit Union Service Organization's proposed rule and request for comment. It is good to hear your voice back at the board table. I hope that everyone in your house is adjusting well to the addition to your family. And on that note, I should also welcome back Board Member Hoffman after the birth of his son, Jack. I am sure that the both of you have had a lot of sleepless nights lately. This proposal, if finalized, would give CUSOs the ability to become indirect auto lenders and payday lenders. Advocates would agree that these two consumer financial products carry considerable compliance and reputation risk. At the same time, the Ncua has no authority to supervise CUSOs for compliance with federal consumer financial protection laws because we lack the third-party vendor authority for that the other federal banking agencies and the Consumer Financial Protection Bureau have. For these reasons alone, I cannot, with good conscience, support this proposal. But there is much more to dislike about this rulemaking. It would dilute the common bond of a federal credit union. What is more, it would create a wild west within the credit union space with little accountability for protecting consumers. In fact, CUSOs making loans under this proposal would not be subject to the same loan restrictions as federal credit unions. As a result, they could exceed the limits on maturity, interest rates, and prepayments that federal credit unions must follow. That creates real reputational risk for the entire credit union system. Instead of passing this proposed rule today, we should have just passed out get-out-of-jail-free cards. In the recent past, some have suggested that the NCUA should address vendor authority after the COVID-19 pandemic is behind us, and instead, the agency would focus on providing credit unions and their members the relief and support they need to weather the pandemic-induced economic crisis. This proposed rule and associated request for comment do nothing to provide relief for those impacted by the upheaval. As such, I would like to examine why we are even considering this proposal today. It is certainly not COVID-related. There is no economic analysis to make the business case for expanding this unfettered lending authority. While the increased competition seems likely to marginally lower prices for some consumers with good credit, other consumers may end up paying much more for their loans. We would also likely see tighter margins and a more concentrated system as small credit unions close their doors because of an inability to compete created by this proposal. And although the proposal seems to try to explain that it is a reexamination of CUSO authority, there is no information about why the reexamination of the NCUA's 2008 position on CUSO lending is necessary or appropriate. Rachel, I do not have any questions for you about this proposal. My only real question, which I have about a number of items being considered today, is a rhetorical one. Why are we spending our time and valuable staff time on another proposal that is not ready for prime time? Mr. Chairman, I will not belabor these points except to say that I will vote against this proposal. That concludes my remarks.
And thank you, Mr. Harper. I'd now like to recognize Vice Chairman Hauptman.
Thank you, Chairman. I'd be very interested to see further feedback on the proposed rule. I'm going to vote to approve it, partly because autos are increasingly sold online. I'm shopping for a car right now, and I'm not speaking to anyone in person. I'm not speaking to them on the phone. I'm shopping online. And as we know, the sellers of cars are increasingly unwilling to slow down the transaction to deal with credit union challenges. CUSOs have been originating mortgage, business, student credit card loans for a long time without negatively impacting credit unions. I understand what Board Member Harper is saying, but I don't know if the other types of loans that CUSOs are doing, we have seen the problems that I believe he is referring to. The CUSO owned by the credit union would not appear, it would be unfounded to say that a CUSO owned by credit unions would therefore then turn around and do things detrimental to that credit union. One concern I do have, and I'm interested to hear more feedback on it from folks out there who do this for a living, is while this change will help lots of credit unions with indirect lending, there are individual credit unions that do work directly with local auto dealers that already have this process down. It is not a problem for the dealer or the credit union, and we don't want to harm that relationship if that currently works for all parties involved. So I look forward to reading the public's comments, and this is one where I generally want to hear the comments and make sure we craft this correctly. Thank you.
Thank you, Mr. Hauptman, and I too look forward to reading the comments on this. Is there a motion?
I second the motion.
No, I need someone please to make the motion.
Oh, I'm sorry. Yes, there is a motion. Sorry. Hold on, let me get this. I move that the board approve proposed rule part 712 of NCUA's rules and regulations for a 30-day comment period as attached to the board action memorandum.
Is there a second to the motion? Hearing none, I second the motion. There is now a sufficient second. All in favor say aye. Aye. All opposed say nay.
Nay.
Okay, thank you. The ayes have it, and let the record show the motion passed 2-1. And again, we look forward to reading the comments that come in on this proposed rule, Part 712. The third item on our agenda today is the board briefing on Final Rule, Part 747, Statutory Inflation Adjustment of Civil Monetary Penalties. Staff presenting, Gira Bose, Staff Attorney, Office of the General Counsel. Good morning and welcome, Gira.
Thank you, Chairman. Good morning, Chairman Hood, Board Member Harper, and Board Member Hopman. Pursuant to the Federal Civil Penalties Inflation Adjustment Act Improvements Act of 2015, all federal agencies that impose civil monetary penalties, or CMPs, are required to make annual adjustments to the maximum levels of their CMPs to account for inflation. The adjustment calculation itself is based on the percentage difference between the Consumer Price Index for urban consumers over the preceding 2 years. The Office of Management and Budget is required to issue guidance to help agencies fulfill this requirement, including providing the inflation multiplier that agencies must use in their calculations. Agencies do not have the discretion not to undertake this rulemaking. It's a mandatory requirement. The only exception would be if an agency has already made an adjustment to a CMP in the preceding 12 months in an amount greater than required by this statute. In that case, the particular CMP would not have to be adjusted. The NCUA did not make any such adjustments to any of its CMPs, so that exception does not apply, and the agency is bound to comply with this annual requirement. The timeframes for finalizing this rule are narrow, with the OMB guidance being issued only 1 month before the rule must be published in the Federal Register. As a result, the statute permits agencies to bypass the usual Administrative Procedure Act process and move straight to a final rule. The board approved this rule by notation vote on December 30th, and it was published in the Federal Register on January 7th. I'd be happy to answer any questions. Back to you, Chairman.
Great. Thank you, Gira, for your presentation, and most importantly, thank you for your hard work on the Civil Monetary Penalty Inflation Adjustment Rule. Congress has mandated that all federal agencies that have the authority to impose civil monetary penalties, or CMPs as you mentioned, they all must be able to adjust the maximum levels of those CMPs to account for inflation. The adjustments must be made on an annual basis and published in the Federal Register by January the 15th of each year. As part of the process, the Office of Management and Budget must issue guidance to agencies on implementing the inflation adjustments. That guidance was issued on December 23rd. Because the OMB guidance was not issued until after our December board meeting, and the rule must be published by tomorrow, I would indeed like to thank my fellow board members for their prompt review and approval of this rule. I'm happy to say that the board unanimously approved the rule on December 30th by notation vote. The purpose of today's briefing is to ensure that the public is notified of the board's actions. I just have one question, Gira. Does the rule mean that the agency will now be imposing the maximum each time it imposes a penalty for a violation?
Thank you, Chairman. The answer is no. The statute only requires that agencies keep their CMP maximums adjusted annually. It does not require that agencies actually impose the maximums. In fact, the Federal Credit Union Act requires the agency to consider mitigating factors when determining the amount of any penalty, such as the size of the credit union and the gravity of the violation. This year, due to the financial stress caused by the pandemic, or last year I should say, the agency did not use CMPs and rescinded those that were in process during the third quarter of 2019. Back to you, Chairman.
Great, thank you. I have no further questions. I'd now like to recognize Board Member Harper. Mr. Harper, you've been recognized. The floor is yours.
Thank you so much, Chairman Hood, and thank you, Gira, for your presentation today. I think it is important that we provide transparency to the public about what actions the board has taken, and your briefing today has provided us with a clear understanding of how and why the NCUA board recently voted to adjust civil monetary penalties in our rules. I appreciate the work of staff in making these inflationary adjustments in a timely manner. Mr. Chairman, I have no further comments.
Great. Thank you, Mr. Harper. I'd now like to recognize Vice Chairman Hauptman.
My only comment is to concur with what Board Member Harper just said. We appreciate the work done and agree that the timely inflation adjustments are needed and appropriate at this time. Thank you.
Thank you, Mr. Hauptman. The next item on our agenda today is Final Rule Part 704, Corporate Credit Unions. Staff presenting, Scott Hunt, Director, Office of National Examinations and Supervision, and once again, Rachel Ackman, Senior Staff Attorney, Office of the General Counsel. Good morning again, and thank you for joining us.
Good morning, Chairman Hood, Vice Chairman Hauptman, Board Member Harper. This is Director Scott Hunt. I'm here this morning to recommend approval of a final rule governing a corporate credit union's ability to purchase subordinated debt issued by a natural person credit union. This provision was originally proposed in February 2020, along with several other changes and amendments to Part 704. While the Board acted on these other provisions in October 2020, it suspended action on this rule until the subordinated debt rule was finalized. The Board approved the subordinated debt rule in December 2020. This rule is narrow in scope. It allows a corporate credit union to purchase subordinated debt from a natural person credit union, but with limitation. It requires an investing corporate credit union to deduct any such investment from its Tier 1 capital, the rationale being that such investments are of higher risk. This is consistent with the treatment of capital purchases by corporates to include the purchase of corporate credit union-issued capital. No commenters objected to this rule. This concludes my remarks, and I'd be glad to answer any questions. Back to you, Mr. Chairman.
Great. Thank you, Scott, and thank you for your update this morning. I want to also thank all of you for just bringing this proposed final rule governing corporate credit union purchases of credit union-issued subordinated debt. As Director Hunt mentioned in his remarks, it was prudent to suspend action on this provision until the final rule on subordinated debt was finalized at our most recent board meeting in December of 2020. Said another way, had we acted on this provision when the board approved other changes to Part 704 last October, this would follow the adage of the cart being before the horse. I concur with the recommendation to approve this proposed final rule as it is consistent with the treatment of corporate purchases or other forms of credit union-issued capital. That is, due to the nature of the risk involved, any such investments should be deducted from the corporate's Tier 1 capital. Commenters seem to agree as there were no objections to this proposal. So again, thank you for your presentation. I'll be supporting this recommendation, and I have no further questions, or no questions at all, actually. With that being said, I'd now like to recognize Board Member Harper. The floor is yours.
Thank you so much, Mr. Chairman, and thank you, Scott, for your briefing on this relatively straightforward regulation to update our rules and regulations to clarify that corporate credit unions may purchase subordinated debt instruments issued by consumer credit unions. The matter before us completes unfinished work. We have previously proposed this change, but we did not finalize it when adopting the corporate credit union rule changes in October because the subordinated debt rulemaking remained open. With the completion of that rulemaking in December, now is a good time for us to finalize our work on this unresolved subject. What is more, the final rule is narrowly tailored and targeted to provide corporate credit unions with the same powers and guardrails as consumer credit unions to make limited investments in subordinated debt issued by consumer credit unions. One of these guardrails is particularly important in my view. Because a consumer credit union subordinated debt instrument would be in a first loss position even before the share insurance fund and any private insurance fund or entity, an involuntary liquidation of the issuing credit union would potentially mean large and likely total losses for the holders of those subordinated obligations. In fully deducting such instruments from a corporate credit union's Tier 1 capital, the final rule strikes the right balance between providing corporate credit unions the flexibility to purchase consumer credit union subordinated debt instruments and avoiding undue systemic risk to the credit union system. The corporate credit union crisis of more than a decade ago taught us the importance of mitigating cascading capital calls. Therefore, I am pleased that this rulemaking remembers the lessons of the past. In sum, I will support this final rule Thank you, Mr. Chairman. I have no further remarks.
Thank you, Mr. Harper. I'd now like to recognize Vice Chairman Hauptman.
Thank you, Chairman. I will be voting to approve this. The comments on this were quite positive, and that is obviously a credit to the good work done by our staff. And I also appreciate that we are making it easier for folks to purchase subordinated debt. There's no point in issuing lots of subordinated debt if there are not buyers for it. If that occurs, then the rates will be too high and the capital raising process will not be useful for them. So I am pleased to support this change. No further comments.
Great. Thank you, Mr. Hauptman. Is there a motion?
Yes, this is Board Member Harper. I move that the Board approve Final Rule Part 704 of NCUA's Rules and Regulations as attached to the Board Action Memorandum.
Thank you. Is there a second to the motion?
I second the motion.
There is a sufficient second. All in favor say aye.
Aye.
Aye. All opposed say nay.
Aye.
Aye. The ayes have it, and let the record show the motion pass 3-0. And thank you once again. The fifth item on our agenda today is Notice of Proposed Rulemaking, Parts 700, 701, 703, 704, and 713, CAMELS Rating System. Staff presenting, Tom Fay, Director of Capital Markets, Robert Brunel, Senior Capital Markets Specialist, Office of Examination and Insurance, and Marvin Shaw, Staff Attorney, Office of the General Counsel. Good morning and welcome.
Good morning, Chairman Hood, Vice Chairman Hauptman, and Board Member Harper. I'm joined today by Vicki Narwhal, Associate Director, Office of Examination and Insurance, Rob Bruneau, Senior Capital Market Specialist, Office of Examination and Insurance, and Marvin Shaw, Staff Attorney, Office of General Counsel. We are here to present for your approval a Notice of Proposed Rulemaking that would add a sensitivity to market risk component, or S, to the existing CAMEL rating system and redefine the liquidity risk component, or L, thus updating NCUA's rating system from CAMEL to CAMELS. These changes would also require some technical amendments to sections of NCUA regulations. We are proposing that the NPR would be published in the Federal Register for a 60-day comment period. This concludes my opening remarks, and I will now hand it over to Rob, who will provide you an overview of the Notice of Proposed Rulemaking to adopt a CAMELS rating system.
Thank you, Tom. This is Rob Bruneau. Good morning, Chairman Hood, Vice Chairman Hauptman, and Board Member Harper. I will initially provide background on NCUA's CAMEL rating system, then move into the support for adding an S component and adopting CAMELS. Next, I will briefly describe the proposed new S component and updated L component. Finally, I will discuss the requirements to add S to CAMEL and the related CAMELS project timeframe and cost. NCUA based CAMEL on the FFIEC's Uniform Financial Institutions Rating System, or UFIRS. This rating system is commonly referred to as CAMEL. The FFIEC developed and implemented UFIRS, or CAMEL, in 1979 to assess risk on a system-wide basis. NCUA adopted CAMEL in 1987. Up until then, NCUA used a framework called the Early Warning System. NCUA periodically modified CAMEL to respond to changes in the financial services industry, as well as supervisory policies and procedures. Since 1987, NCUA updated CAMEL 10 times. Each time, the agency informed credit unions of changes to CAMEL through a letter to credit unions. A December 2007 letter to credit unions is the latest CAMEL rating system update and remains in effect today. Over the last decade, we've also seen a significant increase in the total assets in the industry and an increase in the concentrations of longer duration products like fixed rate real estate loans and investments. This change has increased the examiner focus on both interest rate risk and liquidity risk. In practice, the examination process informs the CAMEL rating. The 5 CAMEL components, capital adequacy, asset quality, management earnings, and liquidity and ALM, or asset liability management, are informed by the 7 risk categories: credit, interest rate, liquidity, transaction, compliance, strategic, and reputation. Examiners assess the amount and direction of risk exposure in these 7 categories and determine how the nature and extent of these risks affect one or more CAMEL components. Each CAMEL component is rated 1 to 5. 1 indicates strong financial performance and risk management practices, whereas a 5 indicates weak financial performance and inadequate risk management practices. We should note that the liquidity component, or L, includes 2 risks: liquidity risk and asset liability management. The asset liability management risk evaluates a credit union's exposure to market risk. Adopting an S component for sensitivity to market risk and redefining the L component to evaluate a credit union's liquidity risk exclusively is the substance of the Notice of Proposed Rulemaking regarding Ncua's CAMEL rating system. Adding S and adopting CAMELS would improve the clarity and transparency related to interest rate risk and liquidity risk. The enhanced clarity and transparency is beneficial in a number of ways. It would improve the examination communication of sensitivity to market risk and liquidity risk between examiners and credit unions. Additionally, because of more refined interest rate and liquidity risk assessments, Ncua's monitoring and analysis of interest rate and liquidity risk will improve at both the individual credit union level and across the credit union system. This in turn may improve the allocation of specific resources. From a functional examination perspective, a couple of foundational elements are in place that would facilitate the addition of S. The revised interest rate risk supervision and related guidance that Ncua implemented in 2017 was designed with the prospect of adding the S component. Similarly, the development of Ncua's new examination platform, Modern Examination and Risk Identification Tool, or MERIT, includes the foundation to support adding the S component. Finally, the adoption of CAMELS would create greater consistency with the other banking agencies, as well as approximately 24 state supervisory authorities who use the S component for sensitivity to market risk. Separately, but related to the support to add S, is a 2015 evaluation by Ncua's Office of the Inspector General that reviewed the agency's interest rate risk program. The report concluded that the combining of sensitivity to market risk with liquidity risk in the L CAMEL component might obscure instances of high interest rate risk exposure in a credit union. The report also stated that assessing interest rate risk separately would improve the agency's measurement and monitoring of interest rate risk. The Office of the Inspector General's report from November 2015 recommended Ncua management revise the current CAMEL rating system to add S for sensitivity to market risk and modify the L component to include only liquidity factors. If the board chooses to add S and adopt CAMELS, the existing CAMEL framework would change from 5 CAMEL components to 6. The L component would only include liquidity evaluation content and rating criteria, and the S component would only include sensitivity to market risk evaluation content and rating criteria. Given the FFIEC's rating criteria for S and L are well structured to identify and communicate the level of risk, the proposal uses the same S and L rating criteria as the FFIEC. Other changes to Ncua's CAMEL rating system, if any, will likely be negligible to reduce regulatory burden. There are a number of requirements for Ncua to add S to CAMEL. First, agency staff reference and use CAMEL as a risk management and resource allocation tool. Consequently, a significant number of risk and resource allocation reports, programs, and applications would need to be reprogrammed or revised to accommodate the change from CAMEL to CAMELS. Second, the agency will update examiner guidance regarding independently evaluating the L and S components. Third, Ncua will provide examiner training on the updated CAMELS rating system. Fourth, we propose an industry communications plan so credit unions have the opportunity to become familiar with the new S component and the updated L component. Lastly, while the Camel rating system is not a separate section or part of Ncua's regulations, it is referred to in several places. Consequently, technical amendments to change Camel to CAMELS in Ncua's rules and regulations would be necessary. The timeline to add S will require approximately 1 year, including the steps I just discussed. Therefore, the estimated CAMELS project timeline suggests that the transition from Camel to CAMELS will likely require all of 2021 in an effort to implement CAMELS as early as the first quarter of 2022. While the merit system has been programmed to use an S, there would be incidental costs involving updating existing databases, programs, applications, and reports. The estimated cost to add the S component is approximately $650,000. In conclusion, we believe the proposed rule will enhance the Ncua's system-wide monitoring of interest rate and liquidity risks and improve communication to the industry. This concludes our prepared remarks. We'd be glad to answer any questions you may have.
Thank you, Tom and Rob, for your presentation. I certainly appreciate the work that went into developing this proposed rule and recognize it certainly was a team effort from Examination and Insurance, the Office of the General Counsel, and the Eastern Region. I'm well aware that Ncua has long considered adding S and adopting CAMELS. Given the agency revised the interest rate risk supervision implemented in 2017 and the remarkable work that the Office of Business Innovation and the Office of the Chief Information Officer, they all accomplished this with great aplomb to move forward with the plan examination platform transition from ARIES to Merit in 2021. The timing is both opportune and appropriate. I certainly believe that updating Ncua's rating system to CAMELS will help credit unions more clearly understand the examiner's assessment of interest rate and liquidity risk by assigning separate S and a separate L component rating. This also has been a long and outstanding issue that has been identified by our Office of Inspector General for quite some time now. So I'm glad that the board can finally address this outstanding issue that has been raised by the Office of the Inspector General. Additionally, this transition can be accomplished smoothly and without significant disruption to the exam process. Making the transition to CAMELS will be nearly seamless for the approximately 24 state supervisory authorities that already have adopted the S. The adoption of CAMELS will not change the examination procedures for interest rate and liquidity risk assessments. Examiners will continue considering the interrelationships between and among the 7 risk categories and how they inform 6 rather than 5 CAMEL components when assigning the composite CAMELS rating. An updated rating system will also enhance the information that Ncua uses to meet our obligation to monitor critical risk areas such as interest rate and liquidity. Adopting CAMELS will strengthen our supervision and the transparency of our examination assessments, which improves Ncua's efforts to provide a safe and sound credit union system. I also agree with your statement, Rob, about how the change in the industry asset size and complexity also provides a timely reason to improve the transparency in our rating system for liquidity and interest rate risk. I look forward to and certainly welcome stakeholder comments. As I frequently stated, Ncua encourages comments from all interested parties, and we judiciously consider and evaluate each comment we receive to develop thoughtful, clear, and comprehensive rules. Not only do I want to thank you all for your presentation, but also for the piece around the ongoing training activities that will take place when we do roll out the S in the CAMELS. I do now have a few questions. Will the adoption of the CAMELS rating system impact a credit union's composite CAMEL rating?
Hello, Chairman Hood. This is Rob Bruneau, and I can answer that question. We expect that the adoption of CAMELS will not adversely affect the credit union's composite CAMEL rating. The proposed separation of sensitivity to market risk and liquidity into individual CAMELS rating components will provide improved transparency for both ratings. Currently, examiners combine the risk evaluation of these related but separate risk areas into the L component. The separation into two components provides greater clarity for each risk area's assessment than the current blended L component. Consequently, it would be highly unusual that the separate S and L components would cause an unfavorable change in the composite CAMELS rating. That concludes my answer, Chairman.
Great, thank you. And I know I applauded you earlier for the training activities and outreach that will take place. And just for you to specifically discuss it, what are the plans for examiner training with CAMELS and as it relates specifically to merit?
This is Rob Bruneau again, Chairman. Good question. NCUA staff that assign CAMEL ratings will receive training on the updated CAMELS rating system before implementation. The same training will be available to relevant state supervisory authorities as well. As you mentioned in your comments, the timing to adopt CAMELS is both opportune and appropriate, and we believe that this is the case. The agency plans to launch the merit platform through a series of training sessions in the second half of this year. We plan to coordinate training on independently assessing the S&L components along with that merit training. Additionally, the Office of Business Innovation routinely provides updates on merit developments to NCUA staff. We plan that future updates will include information on the incorporation of S into merit. Furthermore, we will take advantage of other examiner outreach opportunities such as staff webinars and multi-supervisory examiner group meetings within the regions. That concludes my answer, Chairman.
Great, thank you. And I know as you mentioned the outreach efforts and training efforts with the SSAs, I'd just like to highlight that I certainly hope that we will work in partnership with our fellow state regulators, such as the group from NASCUS and Lucy Ito. So if you all have not reached out to her organization yet, I certainly encourage you to reach out to them. They play such a pivotal role in the work that we do with the SSAs. So has there been any outreach to our folks at NASCUS that we work with?
Hi, Chairman. This is Tom Fay. I'll take that question. Yes, we did. And as a matter of fact, just a couple of weeks ago, we briefed them on this project, and we committed to keeping them updated as we reach certain milestones. That concludes my answer.
Great. Thank you, Tom, and delighted to know that you've reached out to NASCUS. And I'd just like to note that Vice Chairman Haltman will now be our agency's liaison to NASCUS. So delighted to know that you've reached out. Just one final question, and that is, can you tell me how do you anticipate communicating the transition from CAMEL to CAMELS to the broader credit union industry? As not all of them may be listening to today's call in our meeting.
Hello, Chairman Hood. This is Rob Bruneau again. I can answer that question, and a very good question. Our goal is to ensure that credit unions have a thorough understanding of the CAMELS update. Our plan will include a letter to credit unions that highlights the addition of the S component and the updated L component. Obviously, the letter would supersede the December 2007 CAMEL letter, but it would provide a comprehensive description of NCUA's CAMELS rating system, along with a frequently asked question section to it. We also anticipate holding an industry webinar as well to support the updated CAMELS letter and possibly a post-webinar frequently asked question document. However, as the transition to CAMELS evolves, we will remain aware of opportunities to discuss and educate the credit union industry. That concludes my answer, Chairman.
Great. Thank you. And thank you all for your thoughtful answers this morning and very insightful presentation. In summary, as I've said earlier, I believe the adoption of CAMELS benefits both the credit union industry and the NCUA. I have no further questions and will clearly be supporting this. I'd now like to recognize Board Member Harper. The floor is yours,
Thank
sir.
you, Chairman. Thank you, Chairman Hood, and thank you, Tom and Rob, for your informative briefing on this proposed rule to add a market sensitivity risk component to the CAMEL rating system. This rulemaking has been a very long time in coming. Nearly a quarter of a century ago, in 1997, about the time I began working on financial services policy issues on Capitol Hill, our sister banking agencies added an S component to the CAMEL system. Since then, 24 of our state counterparts have moved over to the CAMEL system to more accurately assess the risks of the credit unions they regulate. It is long overdue for the NCUA to do the same. Not only have our fellow federal and state regulators seen the wisdom in assessing liquidity risk separate from interest rate risk, but also the NCUA Inspector General called for the agency to take similar action more than 5 years ago. In separating out liquidity risk from interest rate risk, we will ensure that the risk assessments for each of these components are clear and that one component can no longer mask the other component, leading to a false sense of security about a credit union's risk potential. I am pleased that we are finally implementing the Inspector General's recommendation. Initially, the NCUA opted not to use the S component based on the relative lack of complexity in the consolidated balance sheets of credit unions. The world, however, has changed greatly since then. In 1997, just 19% of a credit union's balance sheet was in mortgage-related assets. That figure has more than doubled over the last 2 decades to 42%, a sizable portion of which are in fixed-rate products. Longer duration mortgage assets typically increase an institution's sensitivity to changes in interest rates and require a greater focus on liquidity risk management. By adding a market risk sensitivity component to the existing CAMEL rating system and redefining the liquidity risk component to conform to the standards used by other safety and soundness regulators, we will better protect consumers, credit unions, the Share Insurance Fund, and taxpayers. As I mentioned earlier, many of our state partners have already embraced the CAMELS rating system. Back in 2016, in response to an NCUA board briefing about adopting the CAMELS system, they provided us with some important perspective. In a letter to the agency, the National Association of State Credit Union Supervisors noted that, quote, both regulators and credit unions report positive outcomes with little, if any, additional regulatory burden, unquote, in those states that have adopted the CAMELS system. NASC has also observed that earlier rather than later adoption of a sensitivity rating is prudent. The organization observed that, quote, it behooves credit unions and the regulators to monitor sensitivity to market risk separately from liquidity risk before rates start to rise, not after the fact, unquote. I fully agree. Time is no longer on our side. The economic fallout of the COVID-19 pandemic has led to historically low mortgage rates and a sizable refinancing rate. Those lucky enough to purchase or own a home are locking into long-term mortgages that they will likely keep for many years to come. However, when rates rise again, which they undoubtedly will, credit unions may find themselves in a bind in managing the changing rate environment. Historically, low interest rates could also present future risk problems for the agency. As the 2015 NCUA Inspector General report observed, exposed credit unions without appropriate interest rate risk policies and an effective interest rate risk program pose unacceptable and preventable risks to the Share Insurance Fund. In short, the NCUA's adoption of the CAMELS system is good public policy and long overdue. As a result, I wholeheartedly support this sensible proposed rule and look forward to moving expeditiously with its finalization in the months ahead. Thank you, Mr. Chairman. I have no further comments.
Great. Thank you, Mr. Harper. I'd now like to recognize Vice Chairman Hauptman. The floor is yours, sir.
Thank you, Chairman. I agree that the discrete nature of having the S, interest rate sensitivity, does make sense, and agree that interest rate sensitivity was already being considered in one manner or another, chiefly with respect to liquidity. And obviously, many credit unions were already discretely measuring their interest rate sensitivity. And so one question I have for the team is, since any change has a cost in time and effort in reformatting forms. If it has a cost, obviously it should therefore have a benefit. Do we feel that the credit union world writ large feels that they are getting a substantial benefit for adding liquidity risk to the rating system? And I'm aware the cost here is not that large, so the benefit does not have to be that large, but that's my question. Do you feel that the credit union world, not Ncua, the credit union world thinks that they are getting a benefit from adding a discrete interest rate sensitivity component?
Vice Chairman Hartman, Tom Fay, I'll take that question. I think it comes down to, and you already mentioned it, credit unions discreetly today manage liquidity separately from interest rate risk, and we're seeing that by and large with all of our large credit unions. And so aligning the CAMELS assessment process to that actually makes great sense. In fact, the transparency of examiners assessing those risks separately would align with the credit union. So there would be absolutely probably no cost to a credit union. And in fact, we have to gain only by virtue of transparency and the ability to finalize those CAMEL ratings consistent with the supervisory process that we have. So we think this is a win-win for more Ncua, but the credit unions, by virtue of seeing that align with their own supervision, would be a win as well. That concludes my answer.
Thank you, sir. I'm aware that a little over half the federally insured states use already evaluate it, but if credit unions aren't, if there are some that are not used to discretely evaluating it on the form, I guess that's what I meant by a cost, meaning that, just changing your forms, changing the way you talk about it. But I 100% agree that if a credit union gets a lower mark for liquidity, when in reality it is an interest rate sensitivity issue, as a credit union, I would certainly want that to be discretely measured out. And vice versa, right? I would want to know if I got dinged for liquidity that it was truly a liquidity issue and not an interest rate issue. I remember my years working in the fixed income markets. I can say that when evaluating the price of any piece of debt, we always looked at interest rate sensitivity quite separately from liquidity risk. And I would be remiss without mentioning the fact that every time I hear any discussion of interest rate risk, I am reminded that Ncua's Share Insurance Fund has interest rate issues as well, some risk, given that the Japanification of the United States that is happening with a low interest rate world and what that will mean for the earnings on the Share Insurance Fund going forward. But that is obviously a separate issue, but it is obviously top of mind for those of us at Ncua, given that the Share Insurance Fund obviously faces significant risk due to interest rates. Thank you very much. That concludes my comments. I'll be approving this.
Thank you, Mr. Hoffman. Is there a motion?
Yes, this is Board Member Harper. I move that the Board approve the Notice of Proposed Rulemaking, Part 700, 701, 703, 704, and 713 for a 60-day comment period as attached to the Board Action Memorandum.
Thank you. Is there a second to the motion?
This is Board Member Hauptman. I second the motion.
There is a sufficient second. All in favor say aye.
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 Aye. All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. The next item on our agenda today is Proposed Rule Part 702, Risk-Based Net Worth Complex Threshold. Staff presenting Catherine Metzger, Risk Management Division, Office of Examination and Insurance, and Thomas Zales, Staff Attorney, Office of the General Counsel. Good morning to the two of you and welcome.
Thank you. Good morning. This is Tom Zales. We are here today to present a notice of proposed rulemaking that would amend the definition of a complex credit union for purposes of risk-based net worth. The Federal Credit Union Act requires that the NCUA's system of prompt corrective action, or PCA, include In addition to the statutorily defined net worth ratio requirement applicable to insured credit unions, a risk-based net worth requirement for insured credit unions that are complex as defined by the board. Currently, a credit union is defined as complex and a risk-based net worth requirement is applicable only if the credit union has quarter-end assets that exceed $50 million and its risk-based net worth requirement exceeds 6%. The COVID-19 pandemic has created a vital need for financial institutions, including credit unions, to provide access to responsible credit and other member services to support consumers. As part of ongoing efforts to provide relief to credit unions and simplify Ncua regulations, this proposed rule would raise the asset threshold for defining a credit union as complex for purposes of the current risk-based net worth requirement. Under the proposal, any risk-based net worth requirement would be applicable if a credit union's quarter-end assets exceed $500 million and its risk-based net worth requirement exceeds 6%. I will now turn it over to Catherine to discuss the impact of this proposed rule.
Thank you, Tom. This is Catherine. As Tom noted, a risk-based net worth requirement is only applicable if a credit union's assets exceed the minimum asset size and its risk-based net worth requirement exceeds 6%. Using September 30th, 2020 data, this would provide potential relief to over 1,700 credit unions with assets between $50 million and $500 million that would no longer meet the minimum asset size test of $50 million in determining if they are complex. These credit unions would have to calculate or consider the second determining factor, which is having a risk-based net worth requirement above 6%. The proposed increase to the definition of complex to $500 million will result in 284 credit unions no longer being subject to the risk-based net worth requirement. It is also worth noting that asset growth within the credit union industry as a result of the COVID-19 pandemic has resulted in more than 100 additional credit unions increasing total assets over the $50 million asset threshold from December 2019 to September 30th, 2020. These credit unions previously did not need to calculate the risk-based net worth requirement prior to the pandemic, but would now need to consider this capital framework as a result of asset growth. Another benefit of increasing the complex definition from $50 million to $500 million is the $50 million asset threshold aligns with the definition used to determine if a credit union is complex for the purposes of the Ncua's risk-based capital rule, which has an effective date of January 1st, 2020. The Ncua board, in a 2018 final rule, determined a $500 million threshold was appropriate for defining a complex credit union because these credit unions typically hold a substantial amount of complex assets and liabilities. The 2018 final rule includes more details on the complexity index and complexity ratio used to support the $500 million asset threshold. Even though we're providing potential relief to a number of credit unions, we are able to do so without posing undue risk to the Share Insurance Fund. It's important to note that all complex credit unions, under both the current and proposed rule, meet the risk-based net worth requirement, meaning their actual net worth ratio exceeds the risk-based net worth ratio. In fact, many of these credit unions' net worth levels are well above the regulatory minimum. Also, credit unions with assets between $50 million and $500 million represent almost 16% of the industry assets, while those with assets above $500 million account for over 81% of the industry assets. From a risk perspective, setting the minimum asset size at $500 million would still ensure the majority of the assets in the credit union industry would potentially be subject to a risk-based net worth requirement. As I previously mentioned, there are 284 credit unions that are currently defined as complex and would no longer be subject to the risk-based net worth requirement under this proposed rule. These credit unions account for less than 3% of the total industry assets. Thus, the potential risk exposure to the Share Insurance Fund from excluding these credit unions is minimal. This morning, we are requesting the board approve a proposed rule to increase the minimum asset size for defining a credit union as complex from $50 million in assets to $500 million in assets, with a 30-day comment period. That concludes our prepared remarks. We would be happy to answer any questions.
Great. Thank you so very much, both of you, Catherine and Tom, for your presentation this morning. This proposal clearly aligns with my regulatory philosophy of ensuring regulation is effective and not excessive. It's also important to remember that risk-based net worth is just one tool the agency uses to assess capital adequacy. All credit unions will continue to be subject to a minimum net worth requirement. Additionally, this proposed rule would not alter the NCUA's longstanding expectation that a credit union is considered unsafe and unsound if it does not hold capital commensurate with its risk exposure, even if it's above the regulatory minimum. Even if this impacts a limited number of credit unions today, it is indeed one less constraint to manage against. I do have just a few quick follow-up questions for you both. As we all know, the COVID-19 pandemic has created a lot of uncertainty in credit union operations and the national economy. Facing a potential economic crisis, why should the board consider providing capital relief to credit unions now?
Thank you, Chairman. This is Catherine, and I can address your question. We do anticipate that any economic disruption will impact credit unions and likely result in a declining capital level. Given that, I understand that it may seem counterintuitive to propose a rule that may potentially allow some credit unions to hold less capital. It is important to consider, as an insurer and regulator, the NCUA seeks to strike the appropriate balance between providing for safety and soundness of the credit union industry, while not restricting credit union activities with excessive regulation. This proposal seeks to strike an appropriate balance by tailoring the regulation to those credit unions that, by asset size, pose the highest risk to the Share Insurance Fund. As you noted, by excluding smaller, less complex credit unions, they may be able to make loans, serve members, and invest in programs that build capital in the long term. Based on September call report data, the 284 credit unions that are currently bound by the risk-based net worth requirement, but would be excluded under this proposed rule, account for less than 3% of the industry assets. When faced with an economic crisis, it is even more valuable to tailor rules so that the credit union and agency resources are focused on areas that pose the greatest risk to the Share Insurance Fund. It is likely the agency may see an increase in the number of problem credit unions. Flexibility and time may be necessary to prioritize problems and minimize losses. Additionally, this proposed rule would not change the NCUA's practice of monitoring and enforcing capital adequacy through the supervisory process. We would continue to monitor and address capital deficiencies in individual credit unions, regardless of their asset size. In conclusion, while there may be differences in regulatory philosophies or risk tolerances, this is an appropriately tailored and responsible proposal that would not expose the Share Insurance Fund to undue risk. That concludes my response.
Thank you. And Catherine, thank you for such a detailed response. It's greatly appreciated. I just have one final question. You mentioned that we would continue to monitor and enforce capital adequacy through the supervisory process. Can one of you please explain this a little more and what that means for the industry?
Sure. Thank you, Chairman. This is Tom Zills. Under existing rules, which would not change under this proposal, the NCUA has the authority to place a credit union in the next lower net worth category, require a credit union to maintain higher levels of capital through safety and soundness provisions, or both. Specifically, Part 702 authorizes the NCUA board to reclassify a well-capitalized credit union as adequately capitalized and may require an adequately capitalized or undercapitalized credit union to comply with certain mandatory or discretionary supervisory actions if the credit union is in an unsafe or unsound condition or has not corrected an unsafe or unsound practice. More broadly, Section 702.1b is clear prompt corrective action in no way limits the NCUA's or state supervisors' authority to take supervisory action to address unsafe or unsound practices. Catherine, do you have anything you would like to add?
Thank you, Tom. Yes, this is Catherine. As you mentioned before, prompt corrective action is just one tool to address problem credit unions. We have an expansive examination and supervision program designed to take into account each credit union's operational and financial condition. In fact, our Camel rating system, which is used to evaluate the soundness of credit unions and the degree of risk to the Share Insurance Fund, includes risk-based net worth as just one factor in assessing and rating a credit union's capital adequacy. As outlined in Letter to Credit Unions 7 CU 12, a credit union is expected to maintain capital commensurate with the nature and extent of the risk to the institution and the ability of management to identify, measure, monitor, and control these risks. A credit union's capital adequacy is based upon, but not limited to, an assessment of several factors. So this is just one piece that we would look at when evaluating the supervisory approach. That concludes my response. Thank you.
Great, and thank you both. I really appreciate it. I have no more questions, and now would like to turn the floor over to Board Member Harper. You are recognized, sir.
Thank you, Mr. Chairman. And Catherine and Tom, thank you for your presentation on the risk-based net worth complex threshold proposed rule. And thank you, Scott, for being available to answer any questions. I will have none today. The proposal before us would raise the asset threshold for defining a credit union as complex for the risk-based net worth requirement in Part 702 of NCUA's regulations, and would provide that any risk-based net worth requirement be applicable only to a federally insured consumer credit union with quarter-end assets that exceed $500 million, up from the current $50 million. Hence, this proposal effectively lowers capital standards in the middle of a pandemic-induced economic crisis. On that principle alone, I will vote against advancing this ill-conceived proposal. Even before the economic crisis brought about by the COVID-19 pandemic, I said that the agency's safety and soundness supervisory efforts should focus on the institutions and activities posing the greatest risk to the Share Insurance Fund. In my view, all financial institutions backed by federal share or deposit insurance should hold capital commensurate with the risks held on their balance sheets. In the case of federally insured credit unions, such capital will protect taxpayers and credit union members by helping to either prevent credit union failures or mitigate losses to the Share Insurance Fund when a credit union fails. Additionally, I advocated for safeguards like the revised final risk-based capital rule to be put in place before the next recession or financial crisis, because that is good public policy. As I have repeatedly said, it is better to repair a roof before it rains than to patch it during the storm. Well, the next recession and financial crisis are here, and the proposal before us would weaken capital standards in the middle of this economic turmoil. In my book, deliberately weakening your roof in the midst of a hurricane is bad public policy. Moreover, this rulemaking is a paper exercise. The proposal claims it would provide regulatory relief for those credit unions currently subject to the risk-based net worth requirement between the current $50 million threshold and the $500 million threshold, supposedly 67 credit unions. All these credit unions, however, hold net worth in excess of the risk-based net worth requirement. So the actual provided relief would be to 0 credit unions. And in a hocus-pocus sleight of hand befitting of Harry Houdini, another reason put forth to justify this proposed rule is that it would align the risk-based net worth standards with the risk-based capital rule set to take effect on January 1st, 2022, which, ta-da, would be undone by another item on today's agenda, the advance notice of proposed rulemaking on simplifying the risk-based capital requirement. Once again, we are presented with a proposal that is bad public policy, has nothing to do with helping credit unions and their members weather the economic crisis caused by the COVID-19 pandemic, and is half-baked. As a result, I will oppose this short-sighted proposal. Mr. Chairman, I have no further comments.
Thank you, Mr. Harper. I'd now like to recognize Vice Chairman Hauptman. The floor is yours, sir.
Thank you, Chairman. I'm going to support this proposal, and I'd like to ask the staff just to verify if today is January 14th, 2021, this proposal only affects anybody until New Year's Eve of this year. Is that correct?
This is Catherine. Yes, I can answer that. That is correct, that the RBC rule is slated to go into effect on January 1st, 2022. So this rule would only be in effect till December 31st, 2021.
Okay, and it's a proposed rule, so not quite there yet. So it's possible if this goes through, this could be a 270-day rule, something like that, right? If it goes into effect later on this year.
This is Catherine again. Yes, that is correct.
Yeah. Gotcha. Okay. Given that we're trying to make life easier where we can during the pandemic, not having to do the risk-based net worth for these still relatively small credit unions between 50 and 500. I'm not saying it's a game changer, but would you guys say that it fits into the category of small things that Ncua can do for certain credit unions to make their life somewhat easier this year?
This is Catherine again. Yes, and as we noted, there was over 100 credit unions whose assets grew over that $50 million threshold, which would now have to comply with RBNW. With this change, they would not have to worry about that. And those would be our smaller institutions where they may not be as familiar with the RBNW rule.
Understood. And obviously, if someone starts a new credit union, very small, it has, 15, 20, 25, 30 million. Little credit unions often want to grow up to be larger ones. And I don't think we want to be in the spirit of saying, if you gain assets, we're going to throw a roadblock at you, a massive speed bump if you hit 50, that doesn't actually achieve anything for the Share Insurance Fund or for the credit union members. Catherine, would you agree that, or just tell me your view on this. Let's say none of the credit unions between 50 and 500 actually would have to change their balance sheet whether we did or did not do this rule, meaning they would satisfy either capital standard, right? Whether we did RBNW or what they would have otherwise. Let's say their balance sheets, every single one of them, would not have to make any change regardless of which capital standard was applied. If that is true, let's say, is it accurate to say it still affects them because they will no longer have to comply and calculate this rule?
This is Catherine again. Yes, you are correct. They will no longer have to even look at the calculation or consider whether it will impact their capital framework.
Right. So even if there are no balance sheet changes at all, it still affects those between 50 and 500, even if they wouldn't have to make any adjustments, right? It is fair to say it affects them, this
yes,
proposed rule. Okay.
That is accurate.
All right. Had the last year, or call it 20 years, let's say those between, if this rule had been in effect for the last 20 years and people between 50 and 500 did not have to do risk-based net worth, what's your best guess on how life would have been different for credit union members, credit unions, Share Insurance Fund?
This is Catherine again. I think the biggest issue would be how they would plan for their future balance sheet for those institutions. They may be making strategic decisions to ensure that they maintain net worth in excess of their RBNW requirements in order to maintain or remain well capitalized. So had this rule not been in effect, they may have made certain decisions that would impact lending and investment and so forth that may have provided different services to the membership.
Okay. I guess what I'm getting at is, in order to oppose this, you would have to say that there is substantial harm that would occur if we passed it. So what I'm asking you is, what is the substantial harm that occurred that you I know I'm asking you to guess here, but what is the substantial harm that would have occurred had the threshold been 500 million instead of 50 million in the past?
This is Catherine again. I cannot think of what the substantial harm would have been had this not been in effect previously.
Okay, so if there's, that's what I thought you'd say. So it looks like lowering it to 50 does not have a substantial benefit. We have already agreed that it does have a cost, and things that impose costs without yielding benefits, I think, are not why any of us are in this job. So I will approve this, and that concludes my remarks. Thank you.
Thank you, Mr. Haltman. Is there a motion?
Yes, this is Vice Chair Haltman. I move that the Board approve Proposed Rule Part 702 of NCUA's Board's Rules and Regulations for a 30-day comment period as attached to the Board Action Memorandum. Hope I did that right.
Yes, sir, you did. Thank you. Is there a second to the motion? Hearing none, I second the motion. So there's now a sufficient second. All in favor say aye.
Aye.
Aye. All opposed say nay.
Nay.
The ayes have it, and let the record show the motion passed 2-1. Thank you once again, Catherine and Tom. The next item on our agenda today is NCUA's 2021 Annual Performance Plan. Staff presenting Eugene Sheed, Chief Financial Officer, James Holmes, Supervisory, Budget Analyst, and Lindsay Courage, Office of the Chief Financial Officer. Good morning and welcome to you all.
Good morning, Chairman Hood, Vice Chairman Hopman, and Board Member Harper. This is Jim Holm, and I'm here today to present the NCUA's 2021 Annual Performance Plan and recommend the Board's approval of the plan. The Annual Performance Plan is important to the NCUA because it demonstrates to the agency's employees and our stakeholders the specific work the NCUA will do over the next year to achieve its goals, both in response to and anticipation of ongoing changes in the credit union system and the financial sector. In conjunction with the agency's annual budget and its multi-year strategic plan, we hold ourselves accountable for delivering results to credit union member owners and to the general public. The Government Performance and Results Act sets in law the federal agency's responsibilities for strategic planning and performance management. The Board approved the current NCUA strategic plan at its January 2018 meeting. The strategic plan is the foundational document that sets a multi-year direction for the NCUA's actions and establishes how it should prioritize resources. The annual performance plan, which is what we're discussing today, is guided by the strategic plan and establishes accountability for the performance metrics and milestones the NCUA will track in 2021 to achieve the goals of the strategic plan. To briefly review, the NCUA's strategic goals are 1, to ensure a safe and sound credit union system, 2, to provide a regulatory framework that is transparent, efficient, and improves consumer access, and 3, to maximize organizational performance to enable mission success. As I mentioned, our strategic plan is the framework for agency decisions about major programs, priorities, performance goals, and budgets. As required by law, we will be working throughout the NCUA in the coming year to update the next version of our strategic plan. The performance plan is updated annually to demonstrate our progress reaching the agency's strategic goals and to establish targets for the agency to achieve in the coming year. In our agency's continued effort to integrate planning with budgeting, we worked with offices throughout the NCUA to develop the performance plan concurrently with the 2021-2022 budget, which the Board reviewed and approved in December. In their draft budget submissions, NCUA offices were required to justify how funding and staffing requests for new and ongoing projects would help the NCUA achieve its strategic goals and objectives. As part of the budget process, we also asked offices to identify the specific performance indicators that demonstrate the results of the budget's investments. The CFO's office is responsible for measuring and reporting on progress implementing the agency actions necessary to meet the agency's performance goals. Important indicators in the 2021 Annual Performance Plan before you today include those related to the effectiveness of the NCUA's examination and supervision responsibilities, such as through monitoring the timeliness of examinations, the percent of credit unions with high CAMEL ratings, and the completion of supervisory stress testing on large credit unions, the efficiency in carrying out the NCUA's regulatory program, including through the triennial review of the agency's rules and our diligent efforts to ensure compliance with the rules, and also the quality of the agency's operational support to NCUA employees and the public through our efforts to deliver best-in-class information technology products, human capital management, and financial management services. The current and most recent annual performance plans, as well as the NCUA's strategic plan, our budgets, and our financial statements can all be found on the ncua.gov website. Thank you for your time today. This concludes my presentation, and I recommend the board approve the annual performance plan for 2021. Together with my colleagues Eugene Sheed, the NCUA Chief Financial Officer, and Lindsay Courage, the agency's lead performance analyst, we are happy to answer your questions at this time.
Well, Jim, thank you for your presentation. And I'd certainly like to thank Lindsay, you as well, for the outstanding work that you put forth in the development of the NCUA's 2021 Annual Performance Plan. This year was indeed an iterative process, and thank you for working with all of the board officers to solicit our feedback. The Annual Performance Plan lays out how we will oversee the credit union system and to manage and protect the Share Insurance Fund in the coming year as we continue to manage through the current COVID-19 pandemic. Together with the 2021-2022 budget that the NCUA board approved in December of last year, this plan outlines the resources and strategies that the NCUA will use in furtherance of our strategic goals. It gives stakeholders transparency into our plans and priorities and contributes to a culture of organizational accountability. I believe this plan sets forth performance goals for 2021 that, when met, will make for a stronger NCUA and credit union industry. The actions that the NCUA has taken in 2020 and our planned actions for 2021 will strengthen our ability to deal with the ongoing economic downturn and to adapt nimbly to changes in the credit union industry and the economy. I now just have a few quick questions based on the presentation and the plan. Would one of you please characterize how this plan differs from last year?
Yes, sir. Yes, sir. I was going to refer you to Lindsay to give an answer to that question.
Thank you, Jim. Chairman, this is Lindsay. I'd be happy to answer that question.
Thank you.
The 2021 plan and the 2020 plan both support the 2018 to 2022 strategic plan, as Jim mentioned. The 2021 plan that's before you today reaffirms certain agency initiatives and outlines other new initiatives as supported by the budget. For example, this 2021 plan adjusts agency timelines for initiatives impacted by the COVID-19 pandemic, such as the full rollout of Merit, and provides goals around new initiatives such as access. That concludes my answer.
Thank you. And I just have one final question, and that is, I was delighted to know that there were some performance measurements around the Access Initiative. Could you all please talk about how some of those performance metrics are in this plan?
Chairman, this is Lindsay again. I'd be happy to answer that question. The plan includes a discussion, as you mentioned, of the Access initiatives and adds specific performance measures for items related to Access. The plan does recognize that Access is an ongoing initiative, but it establishes certain metrics for 2021. Specifically, the metric in the annual performance plan before you today states that by March 31st, 2021, the agency will deliver a work plan that includes specific deliverables and milestones for each of the 4 pillars of the Access initiative, and that identifies what other NCUA actions may be taken to close the wealth gap by increasing Americans' access to credit union services, and for the remainder of the year, complete the 2021 deliverables as presented. We've also set goals to charter new credit unions and to implement a new chartering implementation plan. That concludes my answer.
Great. Thank you, Lindsay. That was a really detailed response. And I was especially tune into making sure that the industry realizes that access is not going to be solved in a year, that a lot of the issues that we're seeking to address are intractable in nature, systemic in nature, and will be something that we're going to need to work on diligently for many years to come. So I'm delighted that I have 3 more years in my term to really work with the agency to bring a lot of the ideals and goals of access to fruition. But again, wanted the industry to know that we are not meaning to solve it all in 1 year, so I'm glad that the performance plan does make note that this is an ongoing effort. With that being said, I have no further questions for either of you and will turn the floor over to Board Member Harper. Mr. Harper, you are recognized.
Thank you, Chairman Hood, and thank you, Jim, for your informative presentation. The consideration of the annual performance plan is very important to me. As I said last year, if you are going to measure performance, you need to have metrics to focus the attention of the agency on its priorities. The annual performance plan does just that. This year's annual performance plan evolves from last year's plan and addresses several new priorities. I am especially pleased that this plan incorporates several of my recommendations. For example, to enable continuous risk analysis during the economic fallout related to the COVID-19 pandemic, the plan requires a quarterly review of those credit unions posing a high risk to the Share Insurance Fund. It also requires the development of an initiative to help educate consumers about COVID-19 relief efforts. The 2021 plan additionally incorporates some important consumer financial protection metrics. For example, the Office of Consumer Financial Protection will continue to perform quality control reviews of examination reports to determine whether consumer financial protection supervisory priorities are sufficiently addressed. I have found the information gleaned from last year's quarterly reviews extremely informative. And this year, the annual performance plan provides a mechanism to communicate with credit unions about the common consumer financial protection problems we have identified during these quality control reviews. Economic equality and justice are also extremely important to me. I have spoken often about the need for us to do work in this area during the last year, and we have much work to do. We know that we have a wealth gap created by centuries of systemic racial discrimination, and the credit union movement must live up to its cooperative mission of providing access to credit, including those of modest means. That is why I am very pleased that this annual performance plan requires staff to identify ways the NCUA may take action to support people of color in their efforts to build wealth. In sum, this annual performance plan is a good product. It reflects months of hard work by all offices across the agency, but especially the team in the Office of the Chief Financial Officer. Thank you, Jim, as well as to Lindsay and Eugene and everyone else in OCFO who diligently put this annual performance plan together. I will support this proposal. Mr. Chairman, that concludes my remarks.
Great. Thank you, Mr. Harper. I'd now like to recognize Vice Chairman Hauptman.
Thank you, Chairman. I want to tell the folks that worked on this, I think that everything on today's meeting was well put together, and I can see the work put into it. But I want to say that this item is the one I am the most impressed by. I agree with Board Member Harper on having metrics. As we know, what gets measured is what gets done. And I also agree with Board Member Harper that our number one focus right now is focusing on the credit unions that provide the largest risk to the Share Insurance Fund. None of us want to look back in a year and say we got caught slipping, we missed something. Obviously, we have heightened risk because of the current crisis. It's been said before, but the last financial crisis, that started in the financial sector and then hit Main Street. This pandemic-induced situation is the other way around. It first hit Main Street and then will flow into credit unions and other financial institutions. So there's a lag that is the opposite of what it was in 2008. Regarding the wealth gap, absolutely, that is a major issue, and I appreciate that we're talking about wealth gap and not just income disparities, because they are both important, but they are different. One of the wealth gaps that most disturbs many Americans is the wealth gap between the Washington, D.C. area and the rest of the country. The top 3 richest counties in this country are D.C. suburbs. 6 of the top 10 richest counties in this country are the D.C. suburbs. It did not used to be this way. And I think we probably all agree that the way D.C. has amassed wealth is different than the way most other regions have amassed wealth. Most Americans have to get up and compete in the open market. They have to produce products and services that excel, and they have to do it again the next day. I think, to put it mildly, most of us do not feel that the D.C. region has produced world-beating products and services at competitive prices, and that is how it has earned this its place at the top of the wealth meter. So and every time we in government transfer power here, we're taking food off the plate of somebody else, family in America, and putting a steak dinner for a lobbyist in D.C. And I think that's not the direction we want to go in. We need regulation. We need government. My dad was a 35-year federal employee. I worked in government for years. But I do look forward to working with the other board members and the NCUA team to address why is so much wealth flowing to D.C. and the massive wealth gap between the D.C. area and regular people. And that concludes my remarks. Thank you.
Thank you, Mr. Haltman. Is there a motion?
Yes, this is Board Member Harper. I move that the board approve the NCUA's 2021 Annual Performance Plan as attached to the Board Action Memorandum.
And thank you. Is there a second to the motion?
This is Board Member Hauptman. I second the motion.
There is a sufficient second. All in favor say aye.
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 Thank you. All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. The next and 8th item on our agenda today is a board briefing on the Consolidated Appropriations Act of 2021. Staff presenting Justin Anderson, Senior Staff Attorney, and Anthony Carpetta, Staff Attorney, Office of the General Counsel. Good afternoon, gentlemen, and welcome.
Good morning, Chairman Hood, Vice Chairman Hoffman, and Board Member Harper. This is Anthony Capetta, Director of the NCUA Guaranteed Note Support Division and the Vice President of the Central Liquidity Facility. Enacted on March 27, 2020, the Coronavirus Aid, Relief, and Economic Security, or CARES Act, made several temporary but substantive changes to Title III of the Federal Credit Union Act, which governs the Central Liquidity Facility. As a reminder to our listeners, the Central Liquidity Facility, or CLF, is a mixed ownership government corporation created to improve the general financial stability of credit unions by serving as a liquidity lender to the credit unions experiencing unusual or unexpected liquidity shortfall. Member credit unions own the CLF, which exists within the NCUA, and the CLF group manages the facility under the oversight of the NCUA board. The changes to Title III of the Federal Credit Union Act were to sunset on December 31st, 2020, but the Consolidated Appropriations Act extended them until December 31st, 2021. These changes included increasing the CLF's maximum legal borrowing authority, permitting temporary access for corporate credit unions as agent members to borrow for their own needs, providing greater flexibility and affordability to agent members to join and serve smaller groups of their covered institutions rather than their entire memberships, and providing the NCUA board with more clarity and flexibility regarding the loans it can approve by removing the phrase, "The board shall not approve an application for credit, the intent of which is to expand credit union portfolios." Additionally, on April 13, 2020, the NCUA board approved an interim final rule to make enhancements to NCUA's CLF rule, Part 725, and cohere the regulation with the statutory changes in the CARES Act. These regulatory enhancements, 2 of which are permanent, provided flexibility, relief, and clarity for credit unions. In addition to the cohering changes, the NCUA's regulatory changes included eliminating the 6-month waiting period for new members to receive a loan, easing collateral requirements for certain asset securing loans, and temporarily changing the requirements for a credit union to terminate its membership. I will now hand the presentation over to Justin Anderson to provide an overview of the Consolidated Appropriations Act extension and the NCUA's related regulation. Justin?
Thank you, Anthony. Good morning. This is Senior Staff Attorney Justin Anderson. As Anthony mentioned, the Consolidated Appropriations Act of 2021, among other things, extended the CARES Act enhancements to the CLF. These enhancements were scheduled to sunset on December 31st, 2020. Under the Consolidated Appropriations Act, however, these enhancements will now sunset on December 31st, 2021. Again, as Anthony mentioned, in April, the board passed an interim final rule to, in large part, cohere the Ncua CLF regulation with the changes in the CARES Act. As the Ncua's regulations currently contain the sunset date of December 31st, 2020, as the Consolidated Appropriations Act made statutory changes, the extensions granted by this act are self-effectuating and supersede the Ncua's regulations to the extent the two are inconsistent. To provide additional clarity to all stakeholders, the Ncua board may issue another rule to update the CLF regulation to align the sunset dates with those in the Consolidated Appropriations Act. A regulatory change would also provide the board with an opportunity to update and cohere the expiration of the temporary termination provision that Anthony mentioned earlier. This concludes our presentation, and we are happy to answer any questions. Thank you.
Yes, well, thank you, gentlemen, both for your presentation this afternoon. The extension of the CLF provisions in the CARES Act ensures the CLF will continue to be a vital source of liquidity as we continue to work through and address the economic fallout from the COVID-19 pandemic. I would like to take this time to also thank Congress for their support of NCUA's Central Liquidity Facility. I want to thank them for passing and making these provisions and extending them for us. I'd also like to acknowledge that all of our three board offices did in fact reach out to our contacts there in the House Financial Services arena and also in Senate banking. So again, I'd like to acknowledge that Board Member Harper and Vice Chairman Hauptman, along with myself, we all reached out to our contacts there, and I'm pleased to say that it paid dividends as evidenced by our being here today. As I stated during last April's board meeting, the CLF, a mixed ownership government corporation that serves as a form of liquidity insurance for credit unions, can borrow from the U.S. Treasury and use those funds to make loans to member credit unions and the National Credit Union Share Insurance Fund. This borrowing power was an essential element in helping the credit union system work through the last financial crisis, and it's been important to the credit union industry during the COVID-19 pandemic. Liquidity, like capital, is a pillar of strength and a bedrock upon which the safety and soundness of the credit union system rests. While we hope for the best outcome to the current emergency, we need to prepare for the possibility that the CLF will once again prove vital in addressing the liquidity needs for credit unions and the Share Insurance Fund. I want to emphasize that liquidity needs are of a nature that, if not addressed swiftly and decisively, can translate into rapid financial distress for individual institutions or even the broader credit union system. The actions taken by Congress to extend the CARES Act provisions related to the CLF are important steps that will help the NCUA and the CLF be ready to alleviate potential liquidity strains with expedience to ensure the maximum intended effects are in place at the earliest opportunity. While we're indeed confident that the credit union community will remain safe and sound, the extension of the CARES Act measures will help ensure sufficient liquidity is available. And by working together in a cooperative spirit of which the industry was founded, the credit union community can assist one another, ensuring the system has adequate liquidity and thus maintain the health of the credit union system as we prepare for the economic recovery to come. Finally, to the extent the NCUA's regulations require clarification and updating in response to the recent extension of the CARES Act CLF provisions, I support moving forward with appropriate regulatory amendments. So thank you again for your presentation, and I have no questions at this time. I'd now like to recognize Board Member Harper. The floor is yours, sir.
Thank you, Mr. Chairman, and thank you for your overviews, Justin and Anthony. In December, Congress compromised on a much-needed $900 billion pandemic relief package, which includes relief for credit unions and their members. Although we all recognize that more relief and more work will likely be necessary, this law represents an important step in the right direction. I was happy to work with congressional offices and my fellow board members to help credit unions and their members receive this much-needed relief. My top priority in 2021 is to ensure that the credit union system is prepared to weather any economic fallout related to the COVID-19 pandemic. Credit unions will need liquidity if other parts of our economy freeze up. I appreciate Congress extending the Central Liquidity Facility enhancements to the end of 2021. With these reforms, lending capacity has grown more than fourfold to $32.8 billion since the start of 2020. I strongly encourage all consumer credit unions that do not already belong or have access to an agent or the CLF to join and demonstrate the best of the cooperative movement. I was happy to do my part in helping to have this provision added to the pandemic relief package. The relief package also includes another round of stimulus payments to support households struggling during the pandemic. Congress provided these stimulus payments to cover food, shelter, and medical needs. I was therefore disappointed to read the New York Times reports that some depository institutions, including credit unions, are now poised to target their members' economic stimulus payments to pay for past overdrafts. In my view, this not only undermines what Congress intended, but also the system's mission of cooperative credit and creates a black eye for the industry. I hope that I don't read any more stories like that about credit unions again. The pandemic relief legislation also restarted the Paycheck Protection Program to help small businesses remain open. In total, small businesses could receive $248 billion through the PPP, with an additional $20 billion reserved for businesses operating in low-income communities. Through the Paycheck Protection Program, credit unions are working to save and create jobs. I have personally spoken to many credit unions who leverage the PPP program to help their members. I always like to ask, what is the smallest PPP loan amount they have extended? To date, the smallest is $627. Now that's a mom and pop shop. The pandemic relief legislation also included $9 billion in emergency capital investment programs to provide low-cost, long-term capital investments to minority depository institutions, community development financial institutions that are depository institutions, and $3 billion to the CDFI Fund for financial and technical assistance grants to CDFIs. I look forward to working with the NCUA staff and my fellow board members to implement that program. Mr. Chairman, that concludes my remarks.
Thank you, Mr. Harper, and I want to thank you for acknowledging the great work that our credit unions did in working with the PPP program, and I hope that they continue to do so with this round of funding as well. I'd like to reiterate for the industry, I know I referenced this in our last December board meeting, the credit union industry was able to originate over 171,000 PPP loans for an aggregate amount of $8.4 billion. Most notable is the fact that our MDIs were also quite actively involved with PPP loans, where they made over 6,839 loans for an aggregate amount of $388 million. So again, the credit union stepped up to the plate, so I want to thank you, Mr. Harper, for recognizing that. Mr. Hoffman, I'd now like to recognize you, sir.
Thank you, Chairman. I would just like to agree that it is an opportunity to thank Congress for working quickly, but more importantly for credit unions for everything they did in a very fast situation to not only get PPP loans out, but everything they did to modify and keep their customers happy to the best of their ability. From what we know so far, it appears they have managed to do an enormous amount of good for their members without presenting, at the moment, substantial harm to their balance sheets and to the Share Insurance Fund. Regarding the CLF, it is indeed good. I think we agree that Congress extended it. At some point in the future, it is probably worth another discussion as to what the terms are to use the CLF and who is using it, because it is obviously only supposed to be used for extreme situations to handle liquidity. Credit unions are responsible for obtaining their own financing on the open market, not using a government-backed facility. But yes, of course, we understand why it exists. There are other government facilities for other kinds of financial institutions, but we want to make sure we don't have an incentive situation in the future where people know they have a fallback and don't have to manage their finances quite as well. But yes, I appreciate the work, and that is all I have to say for now. Thank you.
Great, and thank you, Vice Chairman Haltman. And just as Board Member Harper acknowledged the PPP loans, you acknowledged the forbearance activities, and I'd just like to note that based on the most recent data that I have, credit unions were able to make over 1.7 million loan modifications and other activities as a result of the CARES Act, and also that forbearance figure approximated $55 billion, with over 46% of our credit unions all offering some type of forbearance activity. So again, I appreciate how credit unions have stepped up to the plate, and certainly want to give them the regulatory empowerment to continue doing such things in the days ahead. I have no further questions or comments, so we are now ready to move on to our ninth and final item on our agenda today, which is an advance notice of proposed rulemaking, Part 701, Simplification of Risk-Based Capital Requirements. Staff presenting: Tom Fay, Director, Division of Capital Markets; Rick Mayfield, Division of Capital Markets, Office of Examination and Insurance; Rachel Ackman, Senior Staff Attorney; and Ariel Pereira, Staff Attorney, Office of General Counsel. Good afternoon and welcome all of you. Thank you for joining us.
Good afternoon, Chairman Hood, once again, Vice Chairman Hartman, and Board Member Harper. This is Tom Fay. I'm joined today by Myra Tepe, Director, Office of Examination and Insurance; Rick Mayfield, Senior Capital Market Specialist, also Office of Examination and Insurance; and Rachel Ackman and Ariel Pereira, Staff Attorneys from our Office of General Counsel. Today, we are here to present for the Board's approval an advanced notice of proposed rulemaking, or otherwise known as an AMPR, addressing two approaches to simplify its risk-based capital requirement, also known as RBC. We are proposing that the AMPR be published in the Federal Register with a 60-day comment period. So why an AMPR? An AMPR provides a formal invitation for stakeholders to participate in shaping any proposed rule that might follow, which in turn could lead to a final rule in implementing this requirement. When the NCUA board delayed the implementation of the final RBC rule at its December 2019 board meeting to January 2022, it concluded that the extension would provide the necessary time to holistically and comprehensively evaluate credit union capital standards and take into account other important factors not yet part of the RBC rule. Issuing an AMPR allows the board an effective way to formally request ideas and opinions about the kinds of additional reforms the board is considering for a risk-based net worth requirement. I will provide a brief overview of the current RBC rule that is scheduled to go into effect on January 1st, 2022, mainly to provide a perspective and hopefully help in distinguishing the merits of the two simplified RBC alternatives that Rick will provide an overview of as part of soliciting comments in this AMPR. The final RBC rule, as it currently stands, requires complex credit unions, which are federally insured credit unions with total assets over $500 million, to meet an RBC requirement, which is a complement to the statutory PCA net worth ratio requirement, which is often referred to as the leverage ratio. Both requirements provide a set of capital adequacy standards, which serve as a tool to protect the safety and soundness of individual credit unions and the credit union system as a whole. More generally about RBC, the risk-based capital ratio is a percentage of equity and accounts available to cover losses divided by risk-weighted assets. Under this approach, a higher risk-based capital ratio is an indicator of financial strength. RBC is a measure of loss absorption ability to assets weighted based on the associated risk and is intended to be forward-looking and reactive to changes in the risk profile of a credit union. As I mentioned, the RBC framework is a calculus of equity divided by risk-weighted assets. The equity component of, or otherwise known as the risk-based capital numerator, is the sum of certain specific equity elements adjusted for credit loss allowances, secondary capital, and the NCU SIF capitalization deposit, and other adjustments. The denominator to the RBC ratio is the credit union's total risk-weighted assets, which is calculated using risk weights against specific types of assets, including a tiered risk weight framework for high concentrations of residential real estate and commercial loans. Once calculated, the RBC ratio is used to determine the complex credit union's capital classification. In summary, the purpose of this ANPR is to solicit insight from stakeholders on the two RBC alternatives with the goal of reducing the burden and complexity for the industry. This concludes my portion of the presentation. I will now hand this over to Rick, who will discuss the two approaches to simplify the risk-based capital requirements.
Thank you, Tom. The proposed ANPR is soliciting comments on two approaches to simplify the RBC requirement. Before I get into specifics of each approach, it should be noted that staff started with the goal of evaluating a capital framework that would be consistent with the following principles. 1, does the framework comply with all statutory and legal requirements? 2, is the framework simpler than the RBNW and RBC methodologies? 3, would the framework be easier to use and understand? 4, does the framework identify risk characteristics triggering a higher capital requirement? 5, in design, would it establish a tiered net worth buffer system? And lastly, would it be designed to align with PCA triggers? The first approach to simplify the risk-based capital requirement would replace the risk-based capital rule with a risk-based leverage ratio requirement. We refer to this as the RBLR. The RBLR would use relevant risk attributes thresholds to determine which complex credit unions would be required to hold additional capital, also known as capital buffers. For example, a complex credit union with low risk characteristics may be required to hold 7% net worth to be well capitalized, and a complex credit union with high risk characteristics might be required to hold an additional capital buffer in addition to the 7% net worth ratio. The RBLR would be complementary to the net worth PCA requirement. This ANPR is requesting comments on the merits of this approach and on the types of risk characteristics that should be included in the risk-based leverage ratio framework, and the types and risk thresholds, and the capital buffers that should be applied. The second approach is simplifying the risk-based capital requirement in adopting a community bank leverage ratio analog, also known as the CBLR in the banking industry. The CBLR analog would not replace RBC, but provide an alternative for qualifying credit unions in meeting the risk-based capital requirement. For purposes of the ANPR, we refer to the credit union equivalent of the CBLR as the Complex Credit Union Leverage Ratio, or CCULR. The CCULR would be modeled after the Community Bank Leverage Ratio framework, which is available to eligible banks and was effective in the first quarter of 2020. Similar to the CBLR analog, a qualifying credit union who meets the threshold requirement of the CCULR and other eligibility requirements would be considered in compliance with the applicable risk-based capital requirements imposed by RBC. The CCULR framework would not replace the RBC framework that is scheduled to be effective January 1, 2020, but provide an alternative to the RBC requirement and would most likely require a higher level of capital than otherwise required to be well capitalized under PCA. This framework would allow eligible complex credit unions to opt into and out of the CCULR framework on a quarterly basis if they meet certain criteria. The Community Bank Leverage Ratio framework has the following characteristics. 1, the bank must meet qualifying criteria. For example, the bank must have total off-balance sheet exposures of 25% or less. 2, the bank must have a minimum amount of Tier 1 capital to qualify for the Community Bank Leverage Ratio. 3, the bank must opt in to the Community Bank Leverage Ratio. And 4, the bank may be involuntarily be subject to RBC if qualifying criteria are not met. The proposed ANPR is requesting comment on whether NCUA should incorporate a similar framework as a companion to the RBC framework. In summary, both RBLR and CCULR approaches may provide meaningful relief for the industry as part of its risk-based capital requirement. This concludes our prepared remarks. We'll be glad to answer any questions you may have.
Great. Well, thank you, Tom and Rick, for your presentation this afternoon. And I'd also like to acknowledge the hard work of Ariel, Rachel, and Myra as well. I appreciate all the hard work that actually went into this ANPR. This ANPR is a result of the final rule in December 2019, delaying the effective date of risk-based capital. In that rule, we stated the delay would provide the board time to consider whether a community bank leverage ratio analog should be integrated into the NCUA's capital standards. Through this ANPR, we are indeed making good on that promise. Throughout my term as chairman, I have tried to reduce the burden on credit unions by providing regulatory relief where possible. Consistent with this theme, this ANPR is soliciting feedback on approaches to provide regulatory relief for risk-based capital. This relief could come in many forms, and this ANPR is soliciting stakeholder feedback on 2 potential frameworks to provide this relief. We do not want to weaken NCUA's capital standards with this potential relief, for I believe doing so would be feckless and irresponsible. We want to, however, continue to have a strong capital standard level while providing targeted relief to complex credit unions on the reporting and measurement burden required to maintain NCUA's capital standards. In this spirit, I would like to encourage stakeholders to submit comments to help NCUA develop a framework to simplify the risk-based capital requirements for complex credit unions. Comments will help NCUA gauge and incorporate stakeholder opinions to develop a well-defined, simplified risk-based capital requirement for complex credit unions. Your opinions are meant to be heard in the ANPR process, and I am personally appealing to stakeholders to submit comments, again, to help us provide regulatory relief to complex credit unions. With that in mind, I do have a couple of questions. Will NCUA be limited to the approaches in the ANPR if we were to issue an NPR?
Chairman Hunt, this is Rachel Ackman. I'll be taking this question. No, an ANPR is used to obtain public comments early in the process of considering a regulatory change. The NCUA is not limited by the options that are listed in the ANPR. After the comment period, the NCUA could issue a proposed rule on either CCULR or RBLR, or it could even issue a proposed rule on an entirely different capital framework. This concludes my answer.
Great, thank you. And then one final question. Would the frameworks presented in the ANPR be less effective at identifying risk?
Chairman Hood, this is Rick Mayfield. I will be taking this question. Both frameworks, the CCULR and the RBLR, are less precise measurements of risk. As with the other banking agencies' community bank leverage ratio, NCUA would likely need to have higher capital requirements for the CCULR and the RBLR framework to offset reduced precision the reduced precision of identifying risk at a complex credit union. This concludes my answer.
And as a follow-up to that, could you perhaps address how this was implemented with the FDIC and how we would probably follow some insights and glean insight from how they rolled it out with their community bank leverage ratio?
Chairman Hood, this is... Oh, go ahead, Tom.
I'll start, Rick. You could add to it. It's interesting, and we've had the benefit of observing the reaction of the banking industry to the CBLR analog. Of course, that was on top of the pandemic because it was effective in March 2020. So we know the community banks were probably a little bit hesitant about switching over to a new capital framework, given that they've already been producing RBC for years. And so the uptake on the take of that CBLR was probably not as big as they expected. However, I think they do understand the benefits of it and probably will revisit this as soon as we can get the effects of the pandemic behind us. That concludes my answer.
Great, thank you, Tom. And I would just note, you all, I'm very pleased from looking at our third quarter industry data from the call reports that the industry today as a whole is at about 10.46% capital. So credit unions remain well capitalized, some 346 basis points beyond the statutory requirement. So the fact that we're looking at this issue doesn't mean that there are any capital issues today. It's just that we're trying to evolve and have 21st century solutions that mirror that to some degree of our other peers in the financial regulatory arena. So thank you all for your help on this ANPR. I have no further questions. I'd now like to turn the floor over to Board Member Harper. You are recognized.
Thank you, Mr. Chairman, and thank you to Rick, Tom, Ariel, Rachel, and Myra for your briefing on this advance notice of proposed rulemaking related to complex credit union capital requirements. Though not yet February, it sure feels a lot like Groundhog Day. Yet again, some are seeking to delay and diminish the NCUA's sensible risk-based capital rules with this proposal. I have long held that all financial institutions backed by federal deposit insurance, including credit unions, should hold capital equal to the risks held on their balance sheets. In the case of federally insured credit unions, if a credit union with greater risk fails, risk-based capital helps to protect and minimize losses to the share insurance fund. That additional money would protect surviving credit unions, their members, and taxpayers. With respect to safety and soundness, the NCUA's supervisory efforts should focus on the institutions and activities posing the greatest risk to the share insurance fund, like concentration risk. Recently, several federally insured credit unions that concentrated heavily in taxi medallion lending led to sizable losses for the share insurance fund. According to the NCUA Inspector General's recent material loss review, just 3 of these failures resulted in an estimated loss of $765.5 million. That is money that surviving credit unions ultimately could have used to increase consumer lending, lower interest on loans, or increase member dividends. After the Great Recession, the FDIC and other banking regulators moved promptly to update and implement their risk-based capital standards. Yet nearly a decade later, the NCUA continues to drag its feet. Why should it take complex, federally insured credit unions with $500 million or more in assets significantly longer to implement their comparable risk-based capital rule than it took for banks and thrifts to implement theirs? That is an uneven regulatory playing field. Capital is the last line of defense that protects the share insurance fund from losses. Capital also protects U.S. taxpayers from having to shore up the share insurance fund, as they did during the Great Recession when the NCUA had to ask Congress for a temporary multi-billion-dollar line of credit from the U.S. Treasury. Pursuant to the Basel Accord, which sets international best practices, no modern financial institution's regulatory system operates without a meaningful risk-based capital component. Not only would the 2015 risk-based capital rule finally bring the NCUA into greater compliance with the Basel framework, it is required by law in the Federal Credit Union Act. That is why the risk-based capital standard is consistent with the cooperative nature of the credit union system and provides comparability to the other federal banking regulators. Because the NCUA's existing risk-based net worth requirement is ineffective, now is the time for the NCUA to move ahead with implementing its already approved risk-based capital standards. This advance notice of proposed rulemaking, however, is a big step backwards. The notice mashes two separate ideas together. One of those ideas is bad. The other has some merit. I would like to start my analysis with the bad idea. This notice proposes an entirely new concept called the risk-based leverage ratio, or RBLR for short. Rubbler sounds a lot like rubble, and therein lies the rub. Regulators want an effective capital system to stand on a strong foundation, not on rubble. We only need to look at the Marina District in San Francisco to understand what a bad idea this is. Much of the area is built on landfill, which is susceptible to soil liquefaction during strong earthquakes. In 1989, a sizable earthquake caused considerable damage to the community. Knowing that it is a bad idea to build on landfill created from rubble, why would we want to build a new capital system for federally insured credit unions based on the same concept? There are at least 4 problems with the rubbish capital concept. First, the contemplated risk-based capital level would be too imprecise and would likely lead to some credit unions holding less capital than is safe and sound. This in turn could lead to greater losses for the share insurance fund, which all surviving credit unions would need to pay. It would also lead to some credit unions holding more capital than is desirable. This in turn could lead to a pullback on lending. Second, if the new proposed capital levels are not comparable to those of banks, the agency will face litigation risk. While our standards for risk-based capital do not need to be identical to those of other federal banking agencies, the Federal Credit Union Act requires that they at least be comparable. A rubbler system, which is really just a leverage capital requirement on steroids, fails that test. Third, most of the rest of the international financial system follows the Basel capital standards, including financial institutions in developing countries. If the NCUA is going to present itself as a world-class regulator, then we should apply comparable capital standards as the rest of the financial world. Finally, the NCUA staff has put a decade worth of work into the risk-based capital rule finalized in 2015, the Subordinated Debt rule adopted by this board in December, and the complex credit union leverage ratio proposal conceptualized in this notice. Absent a compelling reason to dismiss that hard work, the agency should not divert course to a capital simplification project. The rubbler concept serves as little more than yet another attempt to delay the implementation of the 2015 risk-based capital rule. As a safety and soundness regulator, I cannot abide that. Now, I want to focus on the second part of this notice related to creating the complex credit union leverage ratio, also known as the CCULR, and sometimes referred to as cooler. While not ideal, this concept has some merit. Section 201 of the Economic Growth, Regulatory Relief, and Consumer Protection Act directed the other federal banking agencies to propose a simplified alternative measure of capital adequacy for certain federally insured banks. While I would prefer that all credit unions hold capital in proportion to their risk, I also know that the Federal Credit Union Act requires us to develop comparable standards. Therefore, I am willing to consider implementing a similar option in the credit union system for those complex credit unions meeting certain tests. The other federal banking agencies adopted their standards more than a year ago. We have plenty of information on which we could have issued a notice of proposed rulemaking to advance the matter now. Yet, in issuing this good idea in conjunction with a bad idea as part of an advance notice of proposed rulemaking, we are needlessly delaying the rulemaking process.
Good afternoon, everyone. This is NCUA Chairman Rodney Hood. I would like to apologize that we had audio difficulty earlier during our originally scheduled board meeting for January 2021. I'd now like to welcome you all back, and I would like to now call this meeting to order once again. For those of you who are joining us, you will note that we were in the midst of our final agenda item for today, where we were discussing ANPR rule. Hold on one second here, make sure I have it all correct. Advance Notice of Proposed Rulemaking Part 701, Simplification of Risk-Based Capital Requirements. Staff with us presenting were Tom Fay, Director, Division of Capital Markets, Rick Mayfield, Division of Capital Markets, Office of Examination and Insurance, Rachel Ackman, Senior Staff Attorney, Aria Pereira, Staff Attorney, Office of General Counsel, and Myra Tepe from the Office of Examination and Insurance. Board Member Harper had been recognized for his remarks and was in the midst of the remarks when we were disconnected. I now would like to return the floor to Board Member Harper for his comments. Board Member Harper, you are recognized.
Thank you so much, Chairman Hood. And I know that we don't know precisely when we got cut off. So in the interest of time, I will begin my remarks where we believe we approximately got cut off, but I do want to ask permission to submit and include in the record of the meeting my entire remarks as prepared.
Granted.
Thank you so much. Now, I want to focus on the second part of this notice related to creating a complex credit union leverage ratio, also known as a CCULR and referred to by some as a cooler. While not ideal, this concept has some merit. Section 201 of the Economic Growth, Regulatory Relief, and Consumer Protection Act directed the other federal banking agencies to propose a simplified alternative measure of capital adequacy for certain federally insured banks. While I would prefer that all credit unions hold capital in proportion to their risk, I also know that the Federal Credit Union Act requires us to develop comparable standards. Therefore, I am willing to consider implementing a similar option in the credit union system for those complex credit unions meeting certain tests. The other federal banking agencies adopted their standards more than a year ago. We have plenty of information on which we could have issued a notice of proposed rulemaking to advance the cooler concept now. Yet, in issuing this good idea in conjunction with a bad idea as part of an advance notice of proposed rulemaking, we are needlessly delaying the rulemaking process. In closing, I cannot support this notice because the rubbler idea is rubbish. And while I am cooler to the cooler concept, we should have moved directly to a notice of proposed rulemaking. Doing so would have allowed us to provide some simplification of capital standards as Congress intended more quickly and bring the NCUA's rules into greater conformity with the capital standards of banks. Thank you, Mr. Chairman. I have no further comments.
Thank you, Mr. Harper, for your comments, sir. And I, for the record, would, in addition to granting you the opportunity to provide your written statement, I too, because we don't know specifically when remarks were, when we lost our audio, so I too will be submitting my written statement as well so that we can ensure that all of our comments are presented for the board minutes as originally intended.
That makes perfect sense.
With that being said, I'd now like to recognize Vice Chairman Hoffman. Sir, you are recognized.
Thank you, Chairman. I will keep it quick as well, so here's an abbreviated version. Number one thing I think all parties agree on is that different assets do, in fact, have different risks. I think that's fairly clear. Credit unions certainly feel that way. Number two, that does not necessarily mean that human beings in Basel, Switzerland setting it is necessarily the right way to go. I am not here to knock any of the regulators that set risk ratings. They are human beings just like we are, and they are flawed just like we are. But we know from the financial crisis that the risk ratings that well-meaning human beings put on various assets impacted how people behaved, and it was very detrimental during the financial crisis. For example, European Union countries, their sovereign debt was given excellent capital treatment, so people wound up holding Greek bonds. We know what happened with those. For that matter, for a while, there were Italian bonds, Spanish bonds, etc. And that was what they were encouraged to hold by those who set capital standards. Again, I'm not here to knock those who set the capital standards. AAA mortgages got favorable capital treatment, and we know what happened with that. So while we know that different assets have different risks, it is far from clear whether or not policymakers in D.C. or Basel, Switzerland, or wherever have a better handle than credit unions do. But I am acknowledging the point that different assets obviously have different risks. So that said, where does that leave us? We know that assets have different risks, but we also know that human beings are human beings, and the track record of assigning the correct risk weighting is not a favorable one. So where are we? I think the place we should wind up is for some amount of capital, calculated the simple way, at some number, we would agree that the juice is no longer worth the squeeze when it comes to risk-based capital. So I will leave it at that. I do look forward to the comments and try to figure out at what level is it no longer prudent to force people to do risk-based net worth. Thank you. Bye.
Thank you, Mr. Hauptman. Is there a motion?
This is Board Member Hauptman. I second the motion.
No, would you please make the motion, sir?
Oh, I'm sorry. Jesus, I'm sorry. Just a moment. All right. This is Board Member Hauptman. I move that the Board approve advance notice of proposed rulemaking Part 702 of NCUA's Rules and Regulations for a 60-day comment period as attached to the Board Action Memorandum. And I apologize for my lack of knowledge of parliamentary procedure. I'll get better.
Is there a second to the motion? Hearing none, I second the motion. There is now a sufficient second of the motion. All in favor, say aye.
Aye.
Aye. All opposed, say nay.
Nay.
The ayes have it, and let the record show the motion pass 2-1. Ladies and gentlemen, that is the end of our NCUA board meeting agenda for today. There being no further business, we are hereby adjourned.